Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
That's right. Yields moving lower this morning on the back of some fresh econ data. We'll see if the moves continue throughout the day. Let's get right to it with the three things that you need to know this Thursday morning as you prep for the trading day. Yahoo Finance's Josh Schaefer, Jared Blickery, and Madison Mills have more.
Investors are digesting a fresh batch of econ data. The U.S. economy grew at a rate of 1.4%, in line with estimates in the first quarter. We're also looking at the labor market, where 233,000 people filed for first-time unemployment benefits last week. That's down from the previous reading.
Plus, shares of Micron under pressure on the back of its quarterly results. The chipmaker beating Wall Street's third quarter expectations, driven by demand for its AI memory chips. But the price drop comes amid Micron's current quarter outlook, roughly coming in line with analyst estimates, disappointing investors. The results dragging stocks like Nvidia and AMD lower this morning.
And Amazon hits a historic milestone, the e-commerce giant reaching a $2 trillion valuation for the first time ever on Wednesday. Amazon is now the fifth U.S. company to cross that $2 trillion market cap, joining other big tech titans like Nvidia, Apple, Alphabet, and Microsoft. Shares of Amazon surging more than 25% year to date so far.
Our top story this morning, a slew of economic data. The U.S. economy grew at an annualized rate of 1.4% in the first quarter. That's in line with analyst expectations. We're also looking at the labor market. 233,000 people filed for first-time unemployment benefits last week. That is actually down from the previous reading and below what Wall Street had predicted. So let's get into some of the analysis with Yahoo Finance's own Josh Schaefer. A lot of data coming out here this morning here. What do you think the markets are going to latch on to most here as we're seeing these readings come through?
Yeah, Brad, I mean, I think the general market reaction right now, you saw futures move up a little bit. You didn't see a giant move in yields, right? So I think generally what the market is telling us about this data is it's not overly concerning. Remember, we're sitting near record highs, so to see the market really accept this econ data well and shoot higher, you would probably be looking at something more like an inflation print, not necessarily data of first quarter GDP, which ended in March. But I do think one thing to take out of that GDP print was you saw personal consumption come down again, down to 1.5% on this is the third estimate. The first estimate, it was 2.5, then it came down to 2, then it came down to 1.5%. So we've been talking a lot about sort of a little bit of a consumer slowdown or maybe just a more cautious consumer. And that was what some economists were saying about this print, is that you're seeing maybe perhaps a little bit more of a cautious consumer within that reading. As far as claims goes, that's been an interesting one to watch because it's really been ticking up higher for most of June and through May. Now, that's also the time of year when you look at a longer term initial jobless claims chart, it normally ticks up this time of year. So it's not necessarily unnormal to see that. The thing that's sort of been coupled with is we know the unemployment rate has been rising, right? The unemployment rate is now up to 4% for the first time in a little bit over 2 years. And so to see claims rising with that has sort of been the little bit of, we're starting to get some sort of sign of concern here. So I think the market probably okay with the fact that claims came in lower than last week and lower than the week before. Yes, the general trend has been higher, but we're not moving higher every single week in sort of an obvious direction here. So perhaps there's not a clear read through from claims to this point.
I guess, how do you think the market is ultimately going to read some of these data prints? Because you are right, there's not necessarily anything that's too concerning within these prints, but it's also not painting this picture of growth and something that we had been accustomed to seeing going back over the last couple of quarters. So here we are today, and we are starting to see things slow down. I guess, at what point do you think the market starts to maybe take issue with some of these concerning prints rather than just focusing on exactly what this means for Fed cutting?
It's interesting. It gets into like the good news is good news, bad news is good news, et cetera, right? And I'm talking about good economic news being good for stocks or bad economic news being good for stocks. For the last month or so, we've kind of been in a regime where bad economic news has been good for stocks because it sort of keeps Fed rate cuts on the table because there was a concern that we were running too hot. And if the economy is growing too much, then we're worried about inflation and we might cut. To what extent are we going to get there? I'm not entirely sure. I mean, I think that's kind of the great debate right now. I think it would have to be something in the labor market based on what people have been talking about. That's the number one thing that I think most strategists you guys talk to every day say is it's the labor market is the thing to watch. And so when we talk about the labor market, our most robust print comes next week after everyone wakes up after a tired night of fireworks on July 4th. On July 5th, we're going to get that June jobs report. And I think that's sort of perhaps maybe the key of, okay, does the unemployment rate go up again? And maybe that's when bad news starts to be slightly concerning if you're a truly forward-looking person, because we know once the unemployment rate starts ticking up, it usually keeps moving. And so I think that's one of the key things to watch right now is just how does that sort of build on itself and keep ticking higher. As far as the other side of eco data goes, we have the inflation print tomorrow, and those are always a straight read. You want inflation to come down.
Yeah, I mean, look, thanks for the reminder as well that right after 4th of July, we'll be back here starting up early.
So excited, Brad.
For the jobs report. No, it's gonna be good. I mean, while everybody else is kind of chilling, perhaps they'll want to be able to take in exactly what the jobs market is doing. And you got a lot of data that's coming out on the jobs market next week, whether that be private payrolls from ADP, that's still gonna come out. And then additionally, you've got Fed Chair Jerome Powell, who's going to be speaking in Portugal. So a little bit of a rendezvous for him and an international flair on that testimony, or that speech, rather, that's going to be
No holiday for us, Brad, huh?
No holiday, no.
But it is interesting when you talk about now how the focus should be, or maybe more so is, on the labor market, because that's exactly what Stuart Kaiser from Citi was telling us yesterday. He was saying, hey, the market has been so focused on these inflation prints, they're kind of missing the bigger story, what he views maybe as the more important data points at this part of the economic cycle, which is some of that weakening that we're starting to see within the labor market.
A lot of economists feel like the trend in inflation is there.
Yeah.
It's going to be slow, but it's going to happen.
Yeah.
And so if that trend just continues slowly, you kind of know what's happening there, and then, maybe we should look more at the labor market because you're not exactly sure what's going to happen.
Yeah, exactly. Great point there. All right, Josh, thanks so much. Let's take a look at Micron, because shares are in the red this morning on the back of its earnings print. Despite beating the street's Q3 expectations driven by demand for its AI chips, Micron's Q4 guidance overshadowing those results. The chipmaker's revenue guidance is in line with expectations. Ultimately, though, investors are viewing that as a huge disappointment. The stock has been on a tear, though, since the start of the year. And taking a look at those year-to-date gains, up nearly 67%. Here with a deeper dive into these results and ultimately what it tells us about the AI excitement, we want to bring in Angelo Zeno. He's CFRA's research analyst, along with Jake Silverman, Bloomberg intelligence analyst. Great to see and have both of you. Angelo, let me start with you. In terms of the street's reaction here, we are seeing a pressure on Micron shares. Is that the right read of this report? Because there does seem to be a lot of anecdotes and a lot of data points to be excited about in this print.
Yeah, no, so as far as kind of, the reaction to the stock price here, I mean, fairly muted in nature, and, maybe rightfully so. I mean, you kind of saw, what they did last quarter, and it was kind of a nice beat and raise on both kind of the top and the bottom line side of things. I think going into the print here, there was an expectation out there from the street that you would again see kind of a very nice beat and raise type quarter. You didn't necessarily get that specifically on the top line side of things. But that said, I mean, you did get a lot of kind of good items that we did see. I mean, pricing looked very good on both the DRAM and NAND side of things, increasing about 20% sequentially on both sides of things. Margins look like they're holding up fairly well, and improving. The trajectory looks pretty good on that side of things. But I think the other thing maybe holding up the street a little bit is also kind of the CapEx guidance side of things. The good thing is that they kind of threw it out there now, and we now have that unknown kind of thrown out there for 2025. And you're looking at mid-30s type of CapEx or capital intensity rate going into next year. Probably compares to about 32% here this year. So it's going to grow faster than revenue next year, but that should be expected because of the growth opportunities there related to high bandwidth memory. So overall, it's somewhat of a mixed picture, but Micron is kind of trending in the right direction here.
Jake, want to get your reaction as well here. I mean, the company is talking about being able to drive robust price increases. Industry supply demand conditions continue to improve. Rapidly growing AI demand enabling to grow their revenue by over 50% in this most recent quarter. I mean, what is the read through, especially if things are as mixed as investors and analysts like Angelo are saying this morning?
Yeah, so overall, I mean, we believe that the fundamentals remain pretty positive. We're still remaining pretty optimistic on AI. AI is actually a pretty early stages for Micron specifically. They supply HBM into NVIDIA's H200, and they're going to expand into other customers, as well as potentially additional products within NVIDIA's AI portfolio, such as their Blackwell GPUs. So, overall, we don't think this is specific of read-through over into AI itself. As long as hyperscale CapEx continues to increase quarter to quarter, and there's potentially some upward bias there as well, we remain pretty optimistic overall on AI spend, and we believe that Micron is going to be a particularly strong beneficiary of this.
Angela, we also saw margins recover quicker than anticipated here in the most recent quarter. Is this a trend that you see continuing in the current quarter, and then the quarters to come?
We do. Again, this is, they're coming out of a pretty nasty downturn in 2023. We did see them finally get to profitability in that February quarter. 2 quarters ago, it was the first time in at the 5 consecutive quarters of year-over-year declines in terms, or year-over-year negative earnings. Kind of looked at that momentum continued in the May quarter here, but as you kind of look, we think into 2025, there should continue to be a favorable pricing landscape. High bandwidth memory takes up a lot more wafer supply out there. Part of the reason that you have the need for the higher CapEx numbers out there, but also, that will continue to improve the pricing landscape, the mix, overall mix for Micron, and thus we do expect them to hit record gross margins by the second half of calendar year 2025. So that trajectory should continue to improve. Ultimately, we think by the time you end this cycle, they could potentially see gross margins kind of get to 50% or even north of that.
I mean, in the meantime, Angelo, it sounds like those margins are really going to be pressed by capital expenditures. Exactly what type of spending profile do you expect a Micron to continue to exhibit as they are citing demand as the reason to spend further?
Yeah, I mean, listen, I think you kind of look at 2024 here, and that is a recovery year for the memory industry, right? So you actually have lower CapEx spend in 2024 versus, or lower capacity in 2024 versus 2023. That's going to kind of bump back up in 2025. Now, again, the CapEx number in 25, if you're looking at capital intensity ratio, it's somewhere in the mid 30s. Maybe we're talking about a 13 or 14 billion or so, run rate for CapEx next year. Now, that said, I mean, again, it's all based on kind of the growth opportunities tied to these AI servers, high bandwidth memory. And, we think that, again, is the right way to look at this. Now, you kind of look going into next year. I think maybe the bigger question mark out there isn't necessarily what Micron's doing, but as you kind of hit more of an expansionary year in 2025 from a recovery year this year, what are some of their competitors going to do? What is Samsung going to do in terms of some of their CapEx number, which is the big fish out there? So, that has historically kind of been the concern with these kind of memory upturns. So maybe that is also kind of a little bit of a read-through that you're seeing from some investors out there as we now kind of transition the story from recovery to expansionary phase.
Jake, real quick, going back to what you were just saying a minute ago, you said that you were pretty optimistic overall in AI spend. Do you think Micron's well positioned within that space? My question to you, at least comparing that to what we're seeing from the street's reaction to these results. I think going into this, many people were asking whether or not this report was going to show any hints of a slowdown in terms of AI demand. My takeaway, at least looking at this report, is very much supply is still trying to catch up with demand. Is that a story that you don't really see changing anytime soon?
No, I don't think it really is going to change. I pretty much agree. I think supply remains tight, demand continues to increase, and high bandwidth memory isn't the only story. They're also benefiting from other AI-related products like high capacity DRAM modules, solid state drives. So, ultimately, we just think that pricing will continue to improve as supply remains tight. AI spend continues to increase, and traditional servers, smartphones, and PCs, that demand recovers even at a more modest pace. So yeah, ultimately we remain pretty favorable on Micron's AI opportunity. So it's both high bandwidth memory as well as other AI related products.
Angelo Zeno, CFRA research analyst, and Jake Silverman, who is the Bloomberg intelligence analyst. Great to have both of you here. Thanks so much for discussing Micron with us this morning. Amazon reaching a new market cap milestone. The tech giant becoming the 5th U.S. company to surpass $2 trillion in market value on Wednesday. Yahoo Finance's Madison Mills has the rundown, the breakdown, the run up, whatever you want to call it. Call Amazon having a new record.
They do, Brad. Thanks so much. So shares of Amazon have seen a steady uptick so far this year, rising nearly 30% year to date, and now sitting in the same camps as the big wigs, the Microsofts, Apples, Nvidia, and of course Alphabet here. But as you know, it's been a battle for the most valuable company title. Nvidia's monster rally this year briefly sending its market cap above both Apple and Microsoft last week, making it the most valuable public company in the world for a short period of time. Now, Microsoft and Apple have since taken back those top 2 spots as Nvidia's surge has taken a breather this week. You can see on this chart behind me just the stress that Nvidia as a company has been under over the past 5 days, seeing its worst 3-day slump since December of 2022 and losing over $430 billion in its market cap. But the real battle, of course, here has been between Microsoft and Apple, both of those tech giants fighting to overtake the other in market cap. The current crown sitting with Microsoft, but Apple is close behind here.
All right, Madison, thanks so much for breaking that down for us. Let's take a look overseas and take a look at the currency market. The Japanese yen hitting its weakest level against the dollar since 1986. We're getting some commentary out of Japan's finance minister saying that they will do what it takes to help support the currency, help support the yen. Yahoo Finance's Jared Lickery has the breakdown there for us. Jared.
That's right. It's all speculation about when that next yen intervention is going to take place. And let me just show you the Japanese yen versus the US dollar here. And this is the inverse of what you were just looking at on your screen, where we have 160 yen to the dollar. This shows more intuitively that a lower price means a lower yen. And that's what we're seeing here, as even the Wi-Fi Interactive is syncing on me. Now, here's a 5-year chart, and we can see, my goodness, that is all the way at the bottom. In fact, if we go to a max chart, you're going to find that this goes back to the late 90s. You'd have to go all the way back to 1986 to find something that low with respect to the yen. So I did mention that it's all about Wall Street trying to game when the next yen intervention is going to take place. That is decided by the Ministry of Finance. And all of this comes because the Japanese have been holding their interest rates so low versus the rest of the world. You know, you look at the United States with rates north of 5%. The Japanese just raised them for the first time in decades, and they're at 0.1%. So not a lot of incentive to have currency going into the yen. And in fact, we have something called the carry trade, which is when this is a very prevalent trade over the last 25, maybe longer years, whereby hedge funds will borrow in the yen and invest that money in overseas markets with higher interest rates like the US. All of this to say that huge trade is going to be unwound, but we don't know exactly when. In the Ministry of Finance, whenever they intervene, that could be a potential trigger.
All right, Jared, thanks so much. The Touch really keeping you on your toes here this morning. For Jared, look great. Thank you. Well, we are just getting started here on a morning brief. Walgreens shares are sinking. The stock off nearly 22% in pre-market after slashing its full-year profit outlook. We will break down some top trending tickers next. Plus, are investors loving value meals? Who doesn't? We're going to discuss the latest fast food chain to announce its own cheaper offering. Plus, stay tuned for our 10 a.m. hour of Catalyst. We're going to speak with the CFO of Levi Strauss, the company reporting sales that missed expectations. You're seeing that reflected in the stock price here this morning. Shares are selling off. We've got all that and more. You're watching Morning Brief.
Welcome back. Time for some trending tickers this morning. Walgreens shares plunging after slashing its full-year profit outlook, citing a, quote, continued challenging environment. Yahoo Finance's Anjali Khemlani has the details here. Anjali, this is a massive sinking that we're seeing here pre-market for shares of WBA.
Yeah, Walgreens really facing some pressure from investors right now, basically on that guidance of a second decline in its outlook for the year, profit outlook for the year. It hasn't done any sort of reconfirmation or provided any kind of guidance on revenues for the year. So that's also a reason why investors are really watching this one. I was just listening to the call in which CEO Tim Wentworth was talking a lot about what the plan is, what the strategy is that he's now unfolding for the company. We know that he's new-ish to the job and has really restructured what Walgreens is looking at, pulling away from VillageMD and the providing of healthcare services. So pulling back on that just a little bit. The guidance that we just told you about, just to give you the numbers specifically, looking at 2.8 to 2.95 on the higher end there, and that's a drop from $3.20 to $3.35 previously, and that was narrowing last quarter. So it's really been a lot of shifting to the downside for them. Meanwhile, like I mentioned, the VillageMD pullback, that has actually helped their revenues for the quarter, bringing in a little bit more as they've sort of balanced out where the demand is for that. They've also talked about the back end. Now we know that pharmacies broadly are under pressure in the country, facing a lot of pressure from PBMs, which we know set the rates for them. And so that is something that a big chain like Walgreens is also facing. On the call, CEO Tim Wentworth saying specifically that, quote, we're at the point where current pharmacy model is not sustainable and the challenges in our operating environment require approaching the market differently. And they are in active discussions with PBMs and other payers to align incentives and ensure they are paid fairly. So the complaints we hear from independent pharmacies as well of underpaying, they've talked openly, Walgreens did openly talk about being underpaid for some brands, and they've also faced struggles with more brand medicines being filled, and then on the flip side, generic medicines not being as widely available because of production problems. So more money out the door there as well, since brand medications have lower margins. So all of this, there's so many minutiae to why this is happening today, but that is essentially the story. Is they're now in a sort of reshifting focus of strategy for the company, and all of this is coming together at the same time. And that's why we're seeing this problem.
What does that entail for Boots right now? This is a part of the business they were trying to sell off previously.
They are going to keep it. It looks like those discussions of selling it were off the table because they are looking at the profitability that it has, the opportunity it has. It has supported the revenues largely. So that's something that they're keeping their eye on right now. And that's also in the middle of the store closures they're looking at here. So it's all balancing out. They said something along the lines of closing a portion of 25% of the stores that are underperforming. So lots of moves.
Yeah, certainly lots of moves, and we're seeing consumers under a tremendous amount of pressure, something that they've brought up too this morning. And let's also take a look at GSK, because the CDC here shifting its recommendation for RSV vaccines, and we're seeing the stock under a bit of pressure.
That's right. So based on the data that was presented to an advisory panel this week, the CDC and the advisory panel recommended that those that are older, on the older side of the age gap for seniors, so those who are, say, 65 and older to 70 years old, that's going to be sort of recommended if they have other severe diseases. But then those that are on the older side of that range will have to get just one dose. And so that shrinks the market a little bit for companies like GSK, Pfizer, as well as Moderna. Those are the three companies on the market. We also saw Moderna drop on its results, showing a much lower efficacy than the other two companies when it comes to protection over 2 seasons. So all of that playing a role in sort of what was supposed to be projected as, this 10 billion market opportunity could be a lot less for all these companies combined.
All right, Anj, thanks so much. I want to turn our attention now to some of the big banks here following the latest round of stress test results. The Fed saying all 31 banks will be able to withstand a severe recession scenario. Goldman Sachs shares are, though, taking a hit after analysts saying this morning that the bank is going to have to set aside more capital based on the stress test. And it's also important to point out that Goldman is not alone in this. Wells Fargo is also another bank that analysts see likely having to set aside more capital on a percentage basis. So digging into that just a little bit, Jefferies, the analyst there, Ken Uston, say that most banks are going to see their stress capital buffers increase. Goldman Sachs is going to see a rise of 0.9%. Wells Fargo, an increase of 0.8%. Those two leading the largest banks. We're also seeing some increase likely here in terms of the stress capital buffers for some of the regional banks, Capital One Financial, Fifth Third Bancorp, as well as KeyCorp.
Yeah, some notes on exactly what this is for the viewers out there that are trying to figure out, all right, why do these stress tests happen? What do they actually go through? The stress test essentially shows that large banks have sufficient capital to withstand a highly stressful scenario, i.e. recession or even a mild depression if that were to take place. But in this case, it was really more focused on recession and what some of the equity tiers, the common equity tiers, would be relevant thresholds to remain above here. And all 31 banks, as you mentioned, were able to remain above that minimum, what they call CET1 here. And then under this projected hypothetical losses of nearly $685 billion. Now, overall here, the scenario includes a severe global recession, 40% decline in commercial real estate prices, substantial increase in office vacancies, 36% decline in housing prices, unemployment rate rising nearly 6.5 percentage points to a peak of 10%. So like a wild scenario, but one that they want to ensure that the financial system more broadly, even if there were cracks, that they would be able to try and figure out, okay, what do you need to have in place in order to make sure that there is still strength within the broader financial system should any of these events take place, or if they all happened at the same time here. But a good news environment or scenario here to hear that all of the banks were able to, or 31 banks were able to remain above some of the threshold requirements too.
Yeah, we'll be speaking with Devin Ryan next hour of JMP Securities. He's going to weigh in on these results and also just talk about maybe we should be more focused on the end game here for Basel III and exactly what that ultimately means for the banks. Keep right here on Yahoo Finance. We've got the opening bell next.
It's a live look at the opening bell at the NYSE and at the Nasdaq. At the Nasdaq, you've got Webtoon ringing the opening bell there. You got some funfetti raining down from above. Look at that. And at the NYSE, you've got Grindr ringing the opening bell. Ticker symbol GRND. All right. Kicking off today's trading session here. Happy Pride Month to everyone out there. And you're seeing Grindr opening the bell here at the NYSE. Let's do a quick check of the markets here as we've got the Wi-Fi Interactive loading up. We're standing next to it, so you know it's time to do some clicking here. Dow Jones Industrial Average, that starting off the day flat, just barely to the downside right now by about 0.1%. Nasdaq Composite, you're seeing that flat, barely to the upside. That's holding on to gains of a mere 0.05%. We'll see if we can add on to that. And the S&P 500, you're seeing that flat, barely to the downside as well to begin the trading activity here today. Let's take a look at some heat maps, why don't we, Shauna?
We should, and let's take a look at the sectors here kicking off. You got energy and communication services at least leading the trade for now, very, very early. You've got utilities and financials. They're lagging in just a bit. And digging into some of the movement that we're seeing across the board, a lot of focus this morning on the chip sector following the results that we got out from Micron. You're looking at losses of Micron of just around 5%. Some questions just about the fact that guidance didn't exceed the street's expectations. Some concern there, although we talked to Angela Zeno earlier in the hour saying that the AI trade very much intact. The demand is there. It still remains more of a supply story at this point. You've got NVIDIA off just around 1%. Let's kick it over to Jared Blickery for a closer look at some of the movement that we're seeing. Jared.
That's right. I just want to go back to the main market, the S&P 500 and its cohorts, and show the year-to-date chart. We are right near the top of the trading range over the last week or two, but we've had breadth, the internals of the market, deteriorating. And so for a couple days in a row, we've had more decliners in the S&P 500 than gainers. Meanwhile, the S&P 500 is going up. So that's kind of a rare circumstance. Sometimes that's just a yellow warning flag, so I'll leave it there. I do want to get into some sector action. Yesterday was a big day for consumer discretionary, and that is ticker XLY. It's fourth up today, up only 10 basis points, but over the last 2 days, you can see up 1.5%. And yesterday, that was thanks to the standout efforts of both Tesla and Amazon. And so let me tackle Amazon first. I'm going to put a 5-year chart on here, and you can see after this big cup here, a little bit of a consolidation, not even much of a handle, it is off to the races. So this is the very beginning of a new breakout. So a lot of times that gets momentum. Just throwing that out there. Here is Tesla, and I want to show a shorter time frame chart. Here is year to date. I'm going to put some candlesticks on this. And what we have here is an inverse head and shoulders. Not perfect, but if Tesla is able to surge above 200, that's kind of an important price level right there. I would expect to see some more momentum off of that, and we would target 250, maybe higher. And you could even draw the trend line, inverse head and shoulders trend line, a little bit askew like this, and in that case, it's already broken out. So it depends on how you draw those trend lines. Want to check in on the semis real quick. We just went over those, but want to show kind of a mixed board. So not all is lost when you have one bad earnings report, and it wasn't even that bad. It was just taken by the street to be. And then here's software, the other side of tech. This has been outperforming recently, and maybe it's a little sector rotation. Hard to say, but I'll send it back to you guys on that note.
All right, Jared, thanks so much for breaking down some of the movement that we are seeing. Let's talk about some of that broader action where Jared started the hit here. And you are seeing stocks fall just a bit in today's trading session, although now we are mixed. You've got the S&P and Nasdaq both trading to the upside. The Dow just below the flat line. A slew of econ data prints that were out before the bell. Also, some of those earnings results that Jared was just walking us through here really driving today's trading action. So far this year, though, it's been the same story. It's been all about tech. That has certainly been driving this market's action here. Our next guest, though, raising some concerns about concentration, saying that it actually might pose a risk here to the market in the second half of the year. Kevin Gordon is here to discuss that and lots more. Charles Schwab's director and senior investment strategist. Kevin, it's great to see you. So talk to me about how you're viewing concentration right now. There is this debate about whether or not this is really a huge risk to the market.
Yeah, so concentration in and of itself, if you're looking at, the largest members in any index, the S&P 500 probably the most in focus, the 10 largest being almost 40% of the index, that often gets, sort of pointed to as the thing that's wrong with the market or the thing that's bad. That in and of itself is not necessarily the bad part. The bad part is if you have, a fewer number of stocks that are leading you to all-time highs, and then you have a breakdown in participation and the actual number of companies and the rest of the index that are doing well. That's something that we've started to see over the past few months. It's become a lot more glaring recently. So you've had this tale of two markets where, at the index level, for indexes like the S&P and like the Nasdaq 100, you're consistently making all-time highs this year, which is great, but at the same time, you're not seeing enough of a pickup at the rest of the market. So if that persists into the second half of the year, that's where we'd see more of the risk, where you have maybe a risk of a catch down from the indexes as opposed to maybe more of a catch up from the rest of the index. It's very similar to what you started to see at this point in 2021. It's not an exact replay because we're in a different part of the economic cycle, but in market terms, what you saw in 21 was consistent new highs for the market at the index level, but a breakdown in breadth. And of course, that led you to the bear market in 2022.
Well, it was interesting as well here. As we're talking about concentration, everybody, when they think concentration, they think about the Mag 7. I saw you tweeting about this morning with regard to a range of other things as well, as much as I'd love to talk about the foreign policy implications of pandas.
Yes.
The Magnificent Seven is back at a new all-time high, cohort up by nearly 56% year over year. What does that tell you about the concentration that investors are still willing to dive into at this juncture when you see the Mag 7 still leading the pack here?
Well, I think, I pay more attention to the sectors that group represents, which is really just communication services, tech, and consumer discretionary. And, the price performance for those members, if you look at the top 10 performers in the S&P 500 this year, there's only one in the Mag 7 group or the Fab 5 group that makes it in that list. So large doesn't necessarily mean top performer. But I think within that group or within those sectors, it seems, that in the post-pandemic world, that for now at least, investors have been more willing to treat those areas of the market as defense. Even if you look at the past few months, softer patch of economic data almost across the board, nothing, Armageddon-like, but something that's a little bit softer, but you've had this sort of relentless run into those parts of the market, even though valuations, whether it's for semiconductors, whether it's for parts of comm services, are still, quite stretched. So it just tells us that there's still a huge willingness on the part of, a good chunk of investors to jump into those areas and sort of treat them as defense and not look at the traditional defensives like utilities or staples or even healthcare.
Kevin, I want to go back to what you just said a moment ago. You were talking about some of that, the fact that the broader market lacks participation from many of the stocks. And you actually tweeted a great chart, I believe it was yesterday or maybe it was this morning, about the Russell 2000's performance relative to the S&P. And you compared what we've seen since October 2022 lows and then going back, coming out of previous bear market territory. I'm curious, in terms of the catalyst there, in terms of what is going to turn that around, is it all about rate cuts? What is it going to take in order to spur some of that activity outside of just those handful of
I think
stocks?
to some extent, yes. And what's fascinating about the chart is that in those prior three instances, so this is really the only, the bear markets that we've had in the past 20 years where you've had more than a 20% drawdown. What's interesting in the three that preceded the current one is that first of all, they were associated with recessions. Second of all, these came after the Fed had already gone through a relatively aggressive cutting cycle. So we haven't really had either of those. We've had some form of a rolling recession through the economy, but we certainly haven't had Fed rate cuts. So I do think that, yes, rate cuts are probably a part of that formula where small caps have to do well. However, there is a, much like we talk about with indexes versus what the average member is doing, that's very much the case in an index even like the Russell 2000. Yes, the index has struggled, but if you look over the past year, the companies that are profitable versus non-profitable, the profitable cohort is up by almost 13%. The non-profitable cohort is down by about 2%. So you do have this split even within an index that has a good chunk of, relatively low quality companies. If you were, sort of screening for quality as a small cap investor, you can still find some pretty consistent outperformance. It's just not going to show up at the index level. I think that's the more important takeaway, even though the index itself has underperformed the S&P 500, by a significant degree since the bull market started.
We're about to begin the next earnings season in a few weeks here. What do you think the overwhelming theme that we hear or that prevails could be here?
I think, a couple, one that we've talked about a lot, I know the three of us, just, sales versus profit. So what's the actual demand picture look like versus how much of that profit growth is being achieved via cost cutting? I think the other part too is sort of the price versus volume. What's the actual growth in unit sales looking like? Because, as we go through and continue the disinflation that we've seen over the past year, which is a good thing generally for the economy, it's not always the best for companies that have benefited a lot from inflation. So you have to keep that in mind too and look what actual unit sale growth and unit sale demand looks like on a company by company basis. But I think the more important takeaway from the part of the market is that you're moving into, sort of solidly into double-digit earnings growth territory for the S&P, which is great, but also not consistent with the strongest gains when you look back in the history of the index. So it's not consistent with, an outright decline. But as you move further into the earnings cycle where earnings growth gets better, the market has already started to price that in, so you sort of dial back the expectations.
Kevin Gordon, Charles Schwab Director and Senior Investment Strategist. Great to have you here on set with us.
Thanks.
Great to see you. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief.
Shares of Levi Strauss are sinking today after the company's sales missed expectations in the second quarter. The G maker also saying it plans to cut back on costs by selling more directly to consumers, a strategy that they have now employed now for quite some time. Citi saying, though, that the wholesale business continuing, though, to hold back the company despite some of that brand strength that we did see in the most recent quarter. When it comes to on a regional basis here, the Americas remaining strong. Europe seen as a bit more disappointing. That came in below the street's consensus forecast here. And we're going to talk to the CFO and later on next hour here, Brad. And I think that's a big focal point here for analysts, for investors, just some of the weakness that we are seeing, especially abroad, whether or not that is a trend that we're going to continue to see here in the second half.
Yeah, I'm just smiling here. When's the last time you heard of Dockers as innovation? Well, you're going to hear about that a little bit more from Harmeet Singh when you do speak with him, as they discussed it on the call yesterday. Going forward, leaning into innovation with an expanded head-to-toe collection. They just want Levi's head-to-toe for you, but it's Levi's but by a different name. Performance-based Dockers Go series. They're saying that's exceeded expectations since the launch. Beyond yoga, too. This is going to be interesting to see how they lean into that. Up 13%, acceleration to Q1, driven by strength in wholesale and e-commerce there. And, of course, the space dye business. I'm not as privy to that one. I don't know, maybe that's something that some of our other producers have bought into at this juncture. But one of the huge things here is just wider leg pants and dresses. They're leaning into that. I never thought that would be another strategy that we'd see deployed here once again. So what was early 2000s is once new again.
It is, and I'm still struggling to get on board with it.
Really?
What about my skinny jeans?
I've got some wide leg, but I got them from Madewell though.
You do.
Yeah, I had to try it out. Had to be like the on trend people out there. But I'm going to be listening close to you guys' conversation with Harmeet.
All right, well, thanks. That's coming up on Catalyst. We're going to be speaking with Levi Strauss CFO and Chief Growth Officer Harmeet Singh. That's coming up in the 10 a.m. hour. Brian Sazi is going to join us for that conversation. You won't want to miss it.
I won't.
Better not.
I'll be at my desk just watching. All right, everyone. Let's also talk Nike here on the day. Ticker symbol NKE. Down fractionally right now. It's expected to report fiscal fourth quarter results after the bell on Thursday. Investors are focused on how consumers are holding up amid fears of a spending slowdown, while Wall Street tries to figure out when the company's turnaround plans will fully pay off. For more on what to expect, we've got our very own Josh Schaefer. He's watching all things the swoosh here. All right, so what's going on with them?
Yeah, Brad, Nike has really been a story of slowing revenue growth. So revenue growth that is still increasing, but growing by less and less when you look compared to the year prior. And so the large question here is just when are they going to be able to return to higher sales growth, right? Nike had been a company that grew at a very high sales growth rate for a long time, and then it sort of slimmed. And so they've done a good job from Wall Street's perspective of sort of protecting their margins in this perspective. They're expected to have margins increase again in the fourth quarter. That's going to be reported after the bell today. EPS expected to come in at 85 cents. That's up from 66 cents last year. So from a profitability standpoint, Wall Street isn't too disappointed. The larger story here is, again, back to sales and when they're going to be able to improve that. I know you guys were just talking to Kevin Gordon over at Schwab. That's a theme we're seeing across the market right now, is really some companies just sort of protecting but not necessarily being able to reignite sales. And Nike is one example of that. And the stock, quite frankly, has shown that. You look at shares of Nike over the last year, down about 17.5%. The S&P 500's up 25% in that time frame. It's been a clear underperformer. And so it seems like one of the key things people are looking for out of this is A, the guidance for 2025, because this is the end of 2024, and B, within that guidance, what new products is Nike going to come out with to sort of fight back against some of these competitors? I think we all know the competitors, and at this point, a lot of us are wearing them. And how is Nike going? I'm not currently wearing. I saw Shauna look at my shoes. I'm not wearing Nikes, and I'm not wearing Hoka's. But they've had a lot of competition, right, from companies like Hoka. And how does Nike sort of respond to that and come out with new products that are going to be able to sort of excite people again?
And excite Brad. He's wearing New Balances today.
I got New Balances today. I got some Nikes over there.
Brad, you're a Nike guy. You're a Nike guy.
I wear probably like 4 different brands over the course of the day, shoe-wise.
But do you feel like a lot of the Nike stuff you're buying is remakes of old shoes rather than them coming out with new products?
It definitely is, but certain collaborations, I would say. So they did a collaboration with like Eastside Golf, for instance, and that was one that I bought into because, yeah, it's a great story behind some of the collaborations. And I kind of wrote down 4 points on this, not to cut off your hit here because it's been going amazing, but one of the huge things that I'm thinking about going into this earnings period and this earnings call here, I wrote down 4 things. China, number 1, that's going to be massive. Figuring out where they're continuing to be able to build out the business in that region. Number 2, the Olympics here. This is going to be a massive period where Nike is going to go full speed ahead, despite the fact that you've got Ralph Lauren putting people in space-like jumpsuits to try and figure out, okay, exactly, and some of the preppier gear too, for the opening ceremonies and whatnot. They've been doing that for years. We'll see if that works for Ralph Lauren, but for Nike, it's going to be coming down to the performance. And then demand generation. You can only have the Jordanification of everything for so long before that strategy starts to get old. That's what they talked about last quarter. I've bought into some of the Jordan brand brand golf shoes. It's been great. You're comfortable out there, and you look like you can play basketball. That's awesome, too. And then it's the innovation here. The collaborations, they got the Nike and Hyperice collaboration that was just announced, too. And so where do you see this company start to lean back into the company as a tech platform as well here, as much as, you know, that's going to get poked at by analysts, perhaps. I think for a lot of people, knowing Hyperice and what that brings to your recovery as an athlete, that could work as a strategy here going forward.
I think also the question, though, for Nike is just the brand strength right now in terms of winning back some of the customers that they have lost to some of their competitors out there. So, yes, analysts have been along saying that the lack of innovation has been a huge issue. There's reason, though, to be optimistic maybe about the products that are going to come online here as you look ahead to 2025. But you also got a question about whether or not some of those who used to shop at Nike now are no longer going there because they've gotten used to the fact that they haven't come out with anything new. But looks like
it's a retail company. We can use a little anecdata.
Right.
You walk around New York City, you see more people wearing On shoes and more people wearing Hoka's than you see wearing Nike walking shoes or Nike running shoes, right? How do you kind of get that market back? How do you become cool in the walk-around shoe? Because I agree with what Brad was saying about Jordans. Like, Jordans still have that cool factor to them, right? And it's more of a style play. To me, they're not really in that lifestyle style play where people are walking around with them and they find the comfort and the coolness within that.
Right. I did get the Deion Sanders retros that they re-released, and I feel faster. I'm not faster, though. But
prime time.
Prime time, baby. Josh, thanks so much for joining us here. Fun to break down. All right, guys, all your markets action straight ahead. You're watching Morning Brief. Taco Bell is rolling out a $7 value meal for a limited time. This after a slew of other fast food chains start offering cheaper options in a bid to lure customers back. To discuss how investors are feeling about the value meals, we've got Yahoo Finance's very own Brooke DePalma here. Okay, break down the $7 value meal for us here. What's going on at Taco Bell? How does it compare to the rest?
Yeah, so they're calling this the Lux meal, and that's ultimately because of the fact that consumers right now are thinking that fast food is luxury, and so they're playing into that with this Lux menu box. And ultimately, the $7 price tag, the company says that that's actually a 55% discount if you got each item separately. So you get it in this box, and ultimately, it includes a slew of different items. It includes a Chalupa Supreme, a beefy 5-layer burrito, a double stacked taco, chips, and nacho cheese sauce, as well as a medium drink. But largely what they're doing here, and what many on the street will be watching to see if this works throughout July, and not just for Taco Bell, but all of the companies that have recently introduced their take on a value menu item. We've seen McDonald's, we've seen Burger King, we've seen KFC, we've seen even Starbucks playing into this, and many analysts on the street saying that July will be a pivotal month to see if this strategy works. And there are 3 ways to identify who will win this price competition. Analysts want to see an increase in foot traffic. They want to see more customers in this store while these limited time offerings are being promoted. They also want to see consumers adding more beyond just the value meal. They want to see those premium attachments. They want to see consumers adding more to their ticket. And in addition to that, they want to see a frequency in visits. They want to see consumers come back for this value menu items in addition to other things, but they also want to see consumers come back after. And this is largely in a bid to try to change the perception that fast food is too expensive right now. So yes, these value menus are here for a limited time, but they want to see consumers come back after they're done as well.
You know, it's interesting. I'm looking at some data from Comparably on the Taco Bell NPS, the Net Promoter Score, the amount of people that would be likely to recommend your brand, and they've got a -13 right now, and it's been slipping since this point of last year here. Who is best positioned to win the pricing war, knowing that all of them are going up against whether or not customers would recommend your value meal versus another and be likely to be repeat customers?
Right. So I was at Taco Bell headquarters last week in Irvine, California, and really the CMO there and other executives are really hoping to hit the nail on the head, really get consumers in by saying, yes, this is $7 versus what others are doing at $5,
right,
but we're giving an abundance of a meal. We're giving many different items in their $7 box, and they're really hoping that that lures in competition. They also recently introduced a Cheez-It collaboration. They're also hoping that lures in competition as well. But what Wall Street is really looking for here is who does the best marketing, who does the best advertisements in order to get consumers in the door, and who communicates that they think that their value is best versus the competition. The CMO at Taco Bell actually telling me that he thinks others aren't providing a hearty meal for what they're offering with these value menu items.
All right.
It's all about the value wars now. We'll see who comes out the winner. All right, Brooke DePalma, thanks so much. Keep it right here on Yahoo Finance. Coming up, breaking pending home sales. That's coming up at the top of the 10 a.m. hour. We are going to discuss what the latest data signals about the housing sector and the broader economy. We will also be speaking with the CFO of Levi Strauss following the company's earnings results out after the bell yesterday. Shares selling off in early trading today. We've got that for you next. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today.
A fresh read on the housing market. May pending home sales continue to show some weakness in the overall housing picture. We're going to discuss what that could signal for the broader economy.
And Micron's outlook disappointing the street as the chip company failing to exceed those lofty guidance expectations of the AI era. We're going to have investors set the bar too high. We will discuss.
And we've got the first presidential debate on tap for tonight. This is the first of the 2024 election cycle. We'll dive into what investors need to hear from the candidates when it comes to the economy and more.
All right, we want to start with some breaking news that we have out right now on housing. Pending home sales falling 2.1% in the most recent month here on a month-over-month basis. The estimate was for an increase of 0.5%. When you take a look at some of these other numbers on a regional basis, Northeast sales actually increasing 1.1% on a month-over-month basis. In the Midwest, it fell. In the South, falling 5.5%. In the West, though, it was up 1.4% on a month-over-month basis. Why do we look at this? Well, this is actually a leading indicator, or largely viewed as a leading indicator of existing home sales, which we will get here very soon. But again, pending home sales falling 2.1% on a month-over-month basis, down 6.6% here, Maddie, from the previous year.
Yeah, and this is following new home sales slumping to the slowest pace since November. I find it interesting within the print here, NAR is predicting that mortgage rates are still going to remain above 6% in both 2024 and 2025, and they add that will come despite what the Federal Reserve chooses to do with regards to interest rates. So that indicates to me that could be an issue moving forward for the Fed's inflation targets, because we know that one potential driver of inflation is the fact that people are locked into their houses. We're not seeing as much movement in the housing market. Today's data confirming that with this decrease in pending home sales. That leaves people open to spending opportunities elsewhere, and that could be one potential driver of inflation. We've even heard the president speaking about this. He spoke about it in the last State of the Union in regards to how the challenges in the housing market are potentially fueling broader inflation challenges that the Fed is trying to fight back on. Today's data confirming that. In terms of the market action, though, not a huge impact, at least when you look at the equity space. You're looking at gains across the S&P, though, just around the flat line there, and the Nasdaq is up about 0.3%, Shauna.
All right, let's turn now to the big showdown that's going to be happening just hours from now. Tonight is the first presidential debate of the 2024 election cycle. How much can we expect, or what can we expect, and how will each candidate's policies impact the market and potentially the broader economy? We have our very own Rick Newman here with us. So, Rick, what can we expect tonight?
Well, we're all going to see. We're all going to see who has some stamina and can get to the end after 90 minutes. I mean, this is obviously, I think that's one thing everybody is looking for. But, is this going to affect markets? It's possible there's something that could affect markets a little bit for a short term. Citi has some research out on this. They are getting a lot of questions from their clients. They say, when do we need to start paying attention to the election? When is it going to become a market moving thing? And the answer is probably not yet, even if this debate turns out to be kind of interesting. What is most likely to happen is markets are going to start paying attention to the intricacies of this debate in the fall, September, October. Until then, we have a lot of other things that are going to move markets. We got a whole earnings season to get through. We got several more readings on inflation, unemployment. We have a Fed meeting in July, another in September. So those are the things that markets going to be paying attention to. But I think investors are definitely starting to keep an eye on this and see which way does this seem to be heading.
What about consumers who are just concerned about the state of the economy right now? What should their kind of guide for watching the debate look like heading into tonight?
That's such an interesting question, because consumers think the economy is a lot worse than it is. Mm-hmm. So I think what ordinary people should be listening for, my expectation is there will be a lot of arguing about who is responsible for the inflation that we've had during the Biden administration. If Trump is debating the way he should be debating, he's going to be blaming all of this inflation on Biden and Biden's policies. That's not really correct. Supply chain distortions probably accounted for most of the inflation we saw. But I mean, I don't know that consumers should care that much about what happened in the past. I mean, if you're following the election, I think you care about what is going to happen during the next 4 years. Sure. And you need to be listening for what are they going to do? What are they going to do in the next presidential term? You know, for what it's worth, Biden, as we know, he's kind of promising more of the same. He wants to raise taxes on corporations, but he couldn't do that the first time around. So there may not be that many new changes if Biden gets another term. Trump has a very different sort of agenda. He wants tariffs on all imports, which will raise costs. So Trump may not, let's say Trump wins, he may not be able to do, he may actually choose not to do everything he says he's going to do while campaigning. That's kind of how it went the first time around. But if you raise tariffs, you're raising the cost of imports, and that pushes prices up. And there has already been a fair amount of economic research that says if the Trump tariffs on Chinese imports and all other imports went into effect as expected, it would cost the ordinary household between $1,000 and $2,000. So when you hear tariffs, it might sound like a good idea to protect the U.S. economy, but tariffs means higher prices.
And Rick, real quick, I'm curious the timing of this happening earlier than usual. Any sense as to why that is, or maybe what this then signals about what the next several months are going to look like here?
The Biden administration wanted it to be earlier. They asked for it to be earlier, I think, because they sensed that with Biden tied in the polls with Trump at best and behind by many measures, they could use this as a chance to reset the election. But the good news is we have no debates scheduled over the summer. Go on vacation, go golfing, do whatever you want to do. Go to the pool. Don't worry about missing anything. We have another one scheduled for September. And that's when markets, voters, that's when everybody's really going to be paying attention. So if you can't watch tonight, shame on you, but you're going to get another chance.
Well, we know you'll be watching
for
us, Rick. So
I have a feeling we'll be talking about this tomorrow, maybe at these same chairs.
Hopefully you will be right there next to us, Rick. Thank you so much for joining us. Sure. We really appreciate it. We're going to take a look at markets now, mixed on the back of that fresh economic data. Actually, let me correct that, because markets now just moving to the upside here. You've got the Dow relatively flat, as well as the S&P, but the Nasdaq moving to the upside about 0.2%. That's off of fresh economic data this morning. And what it signals for investors is exactly what we're going to talk about with our next guest. Right now, we've got Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, thanks so much for being here. So, look, we've got new home sales down, continuing claims the highest since 2021, suggesting that it's taking longer for folks to get a job who are looking. Is this moment the tipping point for the Federal Reserve, or have we already passed that?
I actually don't think we're at the tipping point yet. I think we're getting there. I mean, if you recall what Powell's comments were after the first few months of this year, when we were getting economic surprises to the upside, especially in regards to inflation, it took 3 months, right, for him to say that they were losing confidence in the path of inflation. So we've got a little bit of time here where things have been coming in weaker than expected. I don't think just a few reports and a few weeks' time is going to change the outlook for them right now. But if we continue to see this, the continuing claims, the initial claims, those are great reads. The JOLTS number, I think, is something that the Federal Reserve is really watching. Those job openings, the quits number, those are the things that are going to really give them a feel for, is the labor market weakening? And we know that that is the element they're watching right now. Is the labor market going to weaken enough to where it affects consumer spending? Consumer spending has been driving this economy so much with all of the stimulus that's been in play. So I think we're at the beginning of the tipping point, but we're probably not ready to call it that yet.
Victoria, should we be placing more emphasis, or I guess is the more critical report, is it going to be that next jobs print rather than the upcoming inflation prints?
Shauna, it's difficult to say. It's the dual mandate, right? And it seems like the Fed kind of focuses on one or the other, depending on the stability of the numbers that we're seeing. So when they thought inflation was on a steady disinflationary trend, the focus was on the labor market. Then when we got surprise inflation numbers, the focus shifted a little bit. So when we look at the upcoming labor reports, I think there will be a lot of focus, like I said, on job openings, on job quits. There's a lot of volatility that goes in just the monthly number and a lot of seasonality adjustments that fit in there, especially in the summertime. So they will be watching elements of that. I think consumer demand, the sentiment, the confidence numbers are going to be something they watch. And obviously, the inflation component is going to be key, not just overall inflation, but we know it's that super core inflation that they're really watching. So all of that is going to be important for the decision makers.
Victoria, I want to get your take on the broader equity space because you put it out really plainly. You just say you can't stand in the way of the train. Given that you have to be in tech to some degree to bank on this market rally right now, where are you finding an edge?
Yeah, so finding an edge might be a little bit difficult right now because there is such concentration in this market. I mean, you guys know that it's been 5-6 names that have really been driving all of their performance this year. I mean, NVIDIA alone is over a third of year-to-date performance for the S&P. The top 5 or 6 are closer to 75% of return. So you have to have exposure there. What we've been doing is trimming some of those names like NVIDIA as they have their runs, waiting for pullbacks because we know they're going to have them. NVIDIA had them this week. We saw some of the pullback there. So if you don't have exposure, you can have a chance to get in there. But look at some of those other tech names, maybe the less sexy names that are out there, right? Some of the IBM names, some of the other names that maybe are trailing a little bit on these top heavy names, but are still going to benefit overall. I mean, semis by themselves are the top performing sector year to date relative to the S&P, but I also think you need to broaden it out a little bit. Look at some of those more staple, more value names that you can have in your portfolio to help buffer some volatility that I think we'll have for the second half of this year. So whether that's healthcare, whether it's staples, like I said, or even with yields starting maybe to move up closer to 4.5, if the Fed doesn't cut rates, you can add some financials in there as well.
Victoria, anything that you've seen over the last several weeks, and even looking at today, the whipsaw action that we've seen with Micron now under pressure, and actually the earnings results were pretty good. Has the narrative at all changed surrounding the AI story, given the selling that we had seen in NVIDIA earlier this week, and given some of the questions that we are seeing today following Micron's print?
You know, Shauna, you're right. It is this whipsaw. And I think that's the struggle that we have here. If you go all in one way or the other, that can easily come around and bite you in just a couple of days. So I think you have to look at the AI story as being a longer term story, but maybe start to look at some of the secondary effects in terms of what are some of the other companies that will come along and benefit from the AI story. Look, whenever we have this much concentration for performance in the index, following that, it's those lower PE names that really do well. But the question is, how long does that concentration period last? And with AI, it seems we still have a ways to go. I mean, Micron, their earnings were pretty decent. It was just that the outlook was a little bit less. And these days, if you're not far surpassing expectations, your stock comes down. But let's not get it wrong. I mean, we're up considerably in Micron over the last 18 months. So a 5%, 6% pullback isn't going to be that detrimental. But I think you need to be cautious of putting all your eggs in one basket for just those elements.
All right, Victoria Fernandez, as Chief Market Strategist at Crossmark Global Investments. Thanks so much for hopping on with us.
My pleasure.
Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Again, you're looking at all three of the major averages trading to the upside. You've got Nasdaq as the outperformer of the three, up just around 0.4%. We'll be right back. You're watching Catalysts.
Boeing is reportedly facing new whistleblower claims. A former mechanic allegedly observing substandard manufacturing and maintenance practices on the 787's forward pressure bulkhead. That's that dome-shaped piece located in the jet's nose, and it's critical for maintaining cabin pressure. Now, that former employee alleged that he was fired after raising those concerns. He was fired by Spirit, which he was working on this Spirit aircraft at a Boeing hangar in Washington when this occurred. And then later at a Spirit supplier. He says that basically they had to put fasteners into that dome that we were talking about, and holes were drilled that made the fasteners not quite fit into those holes. So he raised those concerns. He said, by the way, that those changes were made without Boeing's permission, according to his statement. He then, moving forward, says that he was fired from Spirit after reporting those issues. He was fired in March of this year, so this is relatively recent. Boeing then saying that they had addressed some of those concerns. So it's just the latest example, though, of this continued challenge, Shauna, for Boeing with regards to these safety concerns from whistleblowers.
It certainly is, and obviously it's very worrisome here. In Spirit, to a statement to Bloomberg, I believe, saying that our leadership is aware of the allegations and looking into the matter. We encourage all Spirit employees with concerns to come forward, safe in knowing they will be protected. But you're exactly right. What this points to, or what this follows, has been a series of whistleblower complaints pointed at Boeing, pointed at its suppliers over some of the manufacturing processes that have been in place at the plane manufacturer here for quite some time. The FAA has received more than 11 times as many Boeing whistleblower reports in the first 5 months of this year compared to all of 2023. So that really puts that in perspective here. The increase obviously coming after that fuselage blew off a plane in mid-flight back in the beginning of the year in January here. So we do have this renewed focus on Boeing. Right now, we are still seeing shares up just around 0.9%. Obviously, the stock has been under a tremendous amount of pressure going back to that incident in mid-January here. So again, lots of questions from analysts just about what exactly the future looks like for Boeing. They will be under a new CEO in the new year. So exactly what management looks like, what some of the issues, how they are going to address some of the issues that have been raised over the last 5 or 6 months, of course, is a critical question here at this point. And we know that we've heard from Boeing's current CEO, Dave Calhoun, saying that they are doing all they can to address some of the issues coming out, saying that they are being proactive in trying to address some of those complaints. But again, we will see how this all shakes out for Boeing in the end. All right, we're also watching some of those big banks today following the latest round of stress test results. The Fed saying all 31 banks would be able to withstand a severe recession scenario. Goldman Sachs shares taking a hit. Analysts saying that the bank is going to have to set aside more capital based on the stress test. We want to bring in Devin Ryan. He's JMP Securities Director of Financial Technology Research. Devin, real quick, before we dive in specifically into Goldman, I just want to take a step back. When you take a look at the results that we did get out last night, did anything surprise you?
At a high level, it wasn't overly surprising. We figured, all banks would pass, and really, you go into the stress test and you hope that all banks are going to pass. And really, then the question is the nuance around that, and then what that implies for capital return, which is really what investors are focused on. I think we all know that banks have built a lot of capital in recent years, and so I would say you look at the banks that passed. 10 were slightly better than where they were last year, and 11 were slightly below where they were last year. So they're really small nuance around the edges versus some major surprise to your question.
So let's talk about the Goldman of it all then. That bank's capital strength, that is, for our viewers, that's their solvency, their ability to withstand financial distress, that declined. What do you think was the single biggest driver behind that?
Yeah, so it declined a little bit, and not overly surprising. If you look at this year's test, it wasn't dramatically different than last year, but the pressure from kind of stressing the credit card portfolio was a little bit of a drag for them. And so, I would point to that as kind of one component of it. Again, these are really small dynamics, and we're much more focused on what this all implies for capital return. I think from a capital position, they're still in a very strong position, as we saw in the test last night. Even these very severe scenarios, But the question then is, what does this imply for how much capital they can return? And we'll get an update on Friday, so tomorrow, from all the banks, and then happy to talk about this. But I think the bigger question is around where capital rules go, and that's really related to Basel III Endgame, which is a whole other conversation. But that's going to be kind of over the next couple of months where we get to the final rules there.
Yeah, Devin, let's talk a little bit more about that, because in the recent note and your reaction note, you're saying that we should be placing maybe a bigger emphasis, or maybe that is more important ultimately to the bank's health here in the future. Talk to us just about what you think we could potentially see from that, given that there are certain, I guess, uncertain factors or uncertainty, because we don't exactly know what exactly Basel III Endgame is going to look like.
Right, exactly. So the initial proposal came out, and I think it made a lot of us and some of the bank executives a bit nervous in terms of where the starting point was for that conversation. And what we've seen in recent months is that it does appear that it's going to get softened. And there's even some press reports earlier this week that the Fed has been floating, a much softer proposal for the final rule, which would really, be a positive for the industry. So I think everybody's just waiting to see what exactly that looks like. And then on the other side of that, then I think companies will have more confidence to really, more broadly accelerate capital return. So of course, you need to get through the stress test and have reasonably good results. I think we got that last night. Again, there was some nuance on the plus side and some nuance on the negative side. And I think you'll see probably modest acceleration in capital return in the announcements tomorrow. But then you'll see a bigger catalyst on the other side of Basel III Endgame in the expectation that it does get watered down, which is everything that we're reading about right now in the press, at least.
All right, we're going to have to leave it there. Devin, thank you so much for joining us. We really appreciate it. That was Devin Ryan, JMP Securities Director of Financial Technology Research. Now, coming up, we are going to speak with the CFO of Levi Strauss after the company reported sales that missed expectations for the second quarter. Stick around for that, coming up.
Shares of Levi Strauss are sinking today, off just about 17% after the company's 8% rise in sales. It wasn't enough to impress investors in the street. The G maker stuck with its full-year outlook of sales growth of 1% to 3%, and now says it plans to cut back on costs by selling more directly to consumers, a strategy that we have seen from Levi Strauss. Let's talk about it with Harmeet Singh. He's Levi Strauss's CFO and Chief Growth Officer, joining us now alongside Yahoo Finance's executive editor, Brian Asazi. Harmeet, it's great to see you again. So let's talk about the quarter, because going into this, lots of questions just about the strength of the consumer, some of the trends that you are seeing. So talk to us about what you saw in the most recent quarter and whether or not that has continued up until today for this most recent quarter.
Good morning, folks. Thanks for having me. It's not the reaction we expected on the stock, but as you know, the stock's had a great run up over the last 12 months, on the belief by us and our investors that our longer term strategies to grow the company to a $10 billion company and deliver operating margins are, fairly strong. Overall, it was a strong quarter for us. We met our revenue expectation and significantly beat our EPS on the back of record gross margin. And as you said, we reaffirmed our full year guidance, which implies an acceleration in the second half, both for revenue as well as profitability. And that's after making investments, higher investments in marketing, because the brand's, having a moment, as well as transforming our distribution and logistics strategy. To your question about, what's really driving our strategy. The first is our direct-to-consumer business, which is now close to half our business, was up 11% on the back of 14% growth a year ago. Second, our women's business is really doing well. It was up 22% in our direct-to-consumer business. And in the US, we are now number one, and that's not something that we could have said a couple of years ago. And so as we think about the US as a marketplace, this is the third consecutive quarter of the US growing. And so as you think about the business around the world, US ahead of expectation, Europe largely on our expectation, Asia slightly down, driven really by foreign currencies impacting their business. And our China business was a little soft, but ex-China, Asia was up 9% in constant currency.
Harmeet, it seems like the street is locking in on the wholesale business, and I understand it did improve sequentially, but it was another quarter of it being down. Should investors just expect that business to be in a long-term structural decline?
You're right. Sequentially, globally wholesale, improved, but it was down. Our view, Brian, is that over the long term, the business will get to modest growth. But what's more important is that wholesale customers that are seeing our new product assortments, the wider loser fit, as we expand our addressable market and get into skirts and dresses for her, or the performance tech pant for him, are beginning to open their checkbooks and buy into the new product line, and that is working. And so I think thinking about this business longer term, our expectation is the wholesale business gets modest growth, but more profitable. The growth, our mid-single-digit growth as a company, that's really driven by our direct-to-consumer business. It's a business that we can directly control, and so that will be the lead. Wholesale is a big, is a big business for us. It's an important business for us, and actually will complement direct-to-consumer. So we talk about the company making a pivot to DTC first, but it's not DTC only. Wholesale will complement our business because we need wholesalers to reach our end consumer just from a distribution perspective and for the wide variety of assortments we offer.
You mentioned expanding the product portfolio to increase your total addressable market. I'm curious from your perspective in your seat as the CFO, what is your thinking when you're looking at the balance sheet on a decision like that? How do you suss out the opportunities that are going to cost you guys a lot but potentially lead to long-term growth versus those that may be expensive and not necessarily give you the ROI that you're looking for?
Yeah, no, it's a very, very good question. Both as CFO and with my growth officer role, as we're making this pivot to a DTC first company, we have a project that's called Fuel, which is really about rewiring the company. We are looking at our go-to-market calendar, and our thought is that we can make it shorter and faster and get a lot more agile. We have already reduced our SKUs, which will begin impacting in the first half of next year by close to 15%, and I think we can go more. By doing this, our view is we create the capacity to really expand the TAM. And we had talked about dresses and skirts for her. We talked about the non-denim offer for him, etc. And so, being thoughtful, because our view is we can improve our inventory turns. Right now, our turns are about 2. We can get to 3 while expanding TAM, while adding SKUs on the stuff that's really working, but actually reducing SKUs on the assortments that are not working. So we're getting a lot tighter. Our global assortments, something that you have and you can offer across the world, we're increasing that by being more directive in an assortment because the consumer is largely similar everywhere and wants our product that's relevant. And so, by ensuring that our common assortments around the world are a lot more than what they are today, I think will just lead to that result.
Harmeet, Levi's is not alone, at least this week, calling out weakness in China. General Mills called it out in its earnings call yesterday, talking about weakness for Haagen-Dazs ice cream bars, which I think caught a lot of people by surprise. No question, weakening consumer sentiment in the country. What's your diagnosis? Is this Chinese consumers having negative sentiment against U.S. brands ahead of the election, or is it product-oriented? How do you guys diagnose what's going on there?
Yeah, we have a wonderful team in China that is looking to grow that business. China imported first, and China is a small piece of a business. It's about 3% of our business. Q2 was, what I call an out-of-sequence quarter because it was lapping the reopening of the Chinese economy a year ago. And, last year, China grew to 95%. And, in Q2, we said the business was down about 10%. But it sequentially, year over year, or month over month, got better as we exited the quarter. I think it's more the macros, Brian, because traffic is under pressure. What we are really doing to bring the consumer back into our store, we are introducing more locally relevant products. So think of Performance School, which is we're making a big play just because it's lighter denim that's working as the world becomes a lot more warmer. So we introduced that's working. The Chinese consumer has a slightly different taste. So we're making the product a lot more locally relevant, like we did in India. And I think that will make a difference over time. We're not planning for a lot of growth in the second half of the year from China. It takes a little while to make the assortment change. But we're really long on international. We expect Europe, for example, to return to growth in the second half. We're seeing that in the orders we're getting from wholesale customers. Our DTC business is sequentially improving. It was up high single digit, and we think that momentum continues. So, thinking about international, international is about 60% of our business. We think it can be a higher business and is obviously higher gross margins. And we have teams on the ground working really hard to get there.
All right, Harmeet, we're going to have to leave it there, but thank you so much for joining us this morning. We really do appreciate it. That was Harmeet Singh, Levi Strauss & Co. CFO and Chief Growth Officer. Also joining us and bringing us this interview, Yahoo Finance's Executive Editor, Brian Sozzi. Thank you so much.
Thanks, team. Bye-bye.
Bye there. Well, Walgreens shares are plunging this morning after slashing their full-year profit outlook, citing a, quote, continued challenging environment. So what should that signal for investors moving forward? We've got Jeff Jonas, Gabelli Funds Portfolio Manager, joining us on this. Thank you so much for coming here with us on this somewhat breaking news this morning, just given the amount of the stock movement that we are seeing. What is your statement to investors who are watching this right now who might own this stock? What should they do with it?
You know, unfortunately, I think I would sell the shares. I just don't see a clear path to a turnaround here. And it's really just in the US where we have a lot of reimbursement pressure in the pharmacy, where we have a weak consumer. And I think it's just in structural decline. And despite new management, despite maybe selling off some non-core assets, I don't really see a turnaround here.
What would it take for you to be convinced of a turnaround? I guess in terms of the strategy, a couple of things that were outlined by the new CEO on the call earlier today, just in terms of the priorities and different initiatives that they are taking, like closing some of their stores. What do you need to see in order to be more convinced of that turnaround?
Well, I definitely would need to see margin improvement, and closing some of those marginally or unprofitable stores could help with that. And then selling off some non-core assets, like maybe Boots in the UK, or maybe selling down some of their ownership in Village MD to pay down debt and strengthen the balance sheet. I think those would be positive steps. I'm just not sure if I see that happening yet.
So given that, do you see a route where this is a company that can't recover, that goes under?
I don't think we're anywhere near that point. I mean, they cut the dividend last year to make it more sustainable and, again, to free up a lot of cash. Again, I think they have assets to sell to pay down debt. But I think it's in structural decline. And, you know, with earnings declining again in next fiscal year, it only trades at about 6 times earnings, but I just don't really see a clear path to growth again.
Jeff, I'm curious, and I'm not sure if you own CVS, but just more broadly speaking, when you take a look at some of the issues that we're clearly seeing at Walgreens and compare that to some of the other trends within the sector, is this more of a Walgreens specific issue, or are we seeing some of this weakness when we talk about consumers no longer spending or maybe trading down, obviously the rampant theft that is occurring really across the retail space? How many of these issues are specific to Walgreens versus broader weakness across the sector?
Yeah, I think these are industry issues. I think they will impact CVS. I mean, with the weak consumer, with higher prices at the pharmacy, I mean, consumers aren't paying that anymore. They're going to Amazon, they're going to Costco or Walmart. So that's forcing the pharmacies to cut price on a lot of those front store items, which directly hurts the profit margins. And CVS has other issues too, where they have challenges in their Medicare Advantage business on the Aetna side of things, and they lost a big pharmacy benefits contract with Centene this year. So I think they have a lot of challenges too.
We've seen more broadly in the healthcare sector a lot of names benefiting off the GLP-1 craze and demand. Why isn't WBA seeing that same benefit?
Yeah, because of their high prices, GLP-1s are actually very low margin for the drug wholesalers who move them to market and for the pharmacies who dispense them. You know, a lot of them need to be frozen, so there's special handling requirements, and they're just incredibly low margin or possibly even no margin for a lot of the people in the supply chain. It's really just the manufacturers who are profiting from this.
Yeah, really good point, Jeff. All right, we're going to have to leave it there, but thank you so much for joining us on this. We really appreciate it. That was Jeff Jonas. He is Gabelli Funds Portfolio Manager. Now, as market valuations continue to cause a lot of concern for investors, what could that mean for upcoming IPOs? We've got all this and more with your markets action ahead. You're watching Catalysts. Fast fashion giant Shein confidentially filed paperwork to list on the London Stock Exchange. That's according to several reports. Now, the retailer has strong ties to China. It previously did try to confidentially file in the U.S., but failed to win broader support, in part due to its use of forced labor practices in its supply chain. So what does this tell us about the state of play for IPOs and company listing decisions? For more on this, we bring in Doug Adams, Citi's co-head of equity capital markets. Doug, thanks for coming in studio with us. I bring up the example of Shein just to get us started about how companies are thinking about where they're going to list when they're making these decisions. What do you think is the biggest driver of that right now?
I think part of it depends a little bit on, first, thank you for having me today. Really appreciate it. Pleasure to be here. Part of the decision goes into where's their client base? How do they think about their business? How well are they known in certain markets? Where are the comparables that they may look to for from a valuation perspective? And also where the target investor universe is. So there's a lot of different dynamics that go into how companies think about the IPO process, where to list, and importantly, when to list. We've seen a pretty significant increase in activity, as you know, versus where we were last year at this point. We're up about 80% in the US, similar levels globally. And I think that's a very constructive environment for companies and for investors.
Yeah, Doug, talk to us a little bit more about that activity, because we certainly have seen an increase in the IPO activity going back over the last couple of months. What does that signal just in terms of the second half of the year? Lots of uncertainty, obviously, when it comes to the Fed, when it comes to rates, when it even comes to the election. Do you think we'll see some of that IPO activity sidelined until towards the end of the year, or how are companies thinking about that?
Look, the pipeline is absolutely building. The dialogue is great. I think companies are still trying to work through some of that. Part of it is the market dynamics, but part of it is their own performance. I think lots of companies are going through their forecasting exercises. How would they have done if they were a public company? And so the one thing we do know is companies will be better prepared to be public companies when they come. I'm not sure if it's all going to come in the second half of 2024. Probably not. When we think about the windows of going public between now and the end of the year, we've got a couple of windows, but there's a lot of uncertainty as you talk about. I do think 25 and 26, we're going to see a significant amount of that pipeline come to market.
What's the catalyst for those companies getting off the sideline? Is it just simply looking at their business? I guess how much of the macro factors have been factoring into some of these decisions versus just the stability of their own balance sheet?
I think the macro factors are influencing individual company performance, and so they're trying to factor that in. So we spend a lot of times with companies talking about what are their KPIs that they'd go to market, and how would they perform relative to those KPIs if they had been public. And importantly, against their forecasts, how would they perform? And so given the rate environment, given some of the economic aspects, given regulatory challenges that some companies face, that's factored into it. And so they're trying to weigh all of this and decide when is the right time to go public and be a good public company, not just go public.
Obviously, the rate cycle is one big factor for these companies, but I'm curious about, from an equities perspective, just the crazy valuations that we've seen. Are you seeing that have an impact on what companies are expecting when it comes to valuations heading into IPOs? Are they looking around and thinking, how do I not have the biggest valuation possible before this IPO?
Yeah, valuations are certainly one of the drivers for companies to go public, but it's one of the drivers. Oftentimes it's what does it mean to be a public company? What is the strategic value of being a public company, the branding? So yes, it's important for going public, but then the sustainability of that in the aftermarket also becomes important. And so lots of companies trying to evaluate, when is the right time to go? How do I think about valuation near term, but also longer term? And what are the growth and margin aspects that they're trying to project to the market?
What are you seeing in terms of the take private activity? Because I believe right around record levels, right?
Yeah, we are. Look, there are a lot of companies. We focus on what the indexes have done, and the S&P is up 15% year to date. And when you look at the equal weighted index, not every company has actually performed at that level. NVIDIA is about a third of that performance year to date. And so lots of companies haven't been caught in this updraft that we've seen in the broader equity markets. And so for some of them, they have to wonder whether or not they're getting properly valued in the public market. So we have seen an increase in activity of companies thinking about, am I better valued in the private market than in the public market at this period in time?
What is that decision looking like then for those companies? Do you expect, to your point, Shauna, do you expect that to continue to be a trend moving forward?
I think there's a lot of money in private equity hands. It's closing in on $3 trillion. You folks have talked about it on many of your broadcasts as well. So the real question is, how do we think about the trade-off of being a public company, the value of being a public company versus the value of being a private company? And so every company kind of evaluates that. Their boards evaluate it, the management teams evaluate it, and really trying to figure out how best to get value for all of their stakeholders.
All right, Doug, we got to leave it there, but thank you so much for joining us. We really appreciate it. Thanks for coming in as well. That was Doug Adams. He is Citi's co-head of equity capital markets. Still ahead here, Micron shares taking a hit today after the company's outlook disappointed the street. Could this be a signal of what's to come in the broader AI space? We're going to discuss that after the break. Micron shares falling today after the company forecast failed to meet lofty expectations that investors had set for the AI space and for this company in particular. Now, this comes off the back of a wild ride for Nvidia this week after the company briefly topped Microsoft as the most valuable in the world. Now that stock is down almost 5% over the course of the last 5 days. So should investors be worried about a potential AI bubble to come? Joining us now is the founding partner of Lead Edge Capital, a venture firm focused on the tech and software sector, Mitchell Green, here with us in studio. Mitchell, thanks for being here.
Thanks so much for having me.
So talk to me about what you're seeing in terms of the concentration, right? Because obviously this is causing some concern for investors who love to say NVIDIA is the new Cisco. Are you seeing this moment as a bubble?
Do the investors who say that, do they say it's overvalued, or do they say we're going to ride Cisco for a while still?
Oh, a little bit of both.
So NVIDIA is a long, if you believe, so we think AI, stepping back, we think AI is very real. We have not made any AI investments ourselves. Happy to walk into why I think it's real. We think it takes a lot longer than it does. But specifically related to NVIDIA, you own NVIDIA today, it's like a $120 stock or whatever roughly it is, probably do $4 to $5 of earnings next year. So it trades at 30 times. Given the growth rates, it's not crazy expensive. I think there's one fundamental thing. If you believe the hyperscale, and they're a long ways away from their competition like AMD and some of these all smaller companies that are attacking at the fringes, but these guys have built an incredible business and incredible chips. If you believe that the hyperscalers who are going to spend giant amount of money. I should say hyperscalers and the Singaporean government and the Middle Eastern governments are going to spend more money next year on this stuff than it's probably a long. If you think that this CapEx could be some sort of slight bubble, it's probably a short. What we think is it's very real, but this stuff is going to take a lot longer to play out than people think. And it's our belief that it's like the telecom bust in the late 90s, early 2000s, where people massively overbuilt capacity. You're going to also, we believe here, see costs come dramatically down over time. If you wanted to build a website in 1997, you went to Sun Microsystems and spent $50 million to build your website. Today, you pull out your credit card, spend $25 and go to GoDaddy. Same thing's going to happen with AI.
So then what does that shakeout look like?
If you are a lot of the VCs plowing money into some of these companies, we think there's going to be lots of zeros. What's interesting in AI is there's three things that people don't think about. One, with the advent of that phone on your desk, the iPhone coming out in 2007, 2006, whenever, how many companies that didn't exist after 2007, that didn't exist before 2007, how many new companies were created that are worth over $100 billion?
Yeah.
3. ByteDance, Pinduoduo, and Uber. Only 3. You know who wins? Incumbents. So the incumbents are the giant incumbents like Salesforce or Microsoft or Oracle or Google or Snowflake. They're all going to win. 2, we've never seen growth rates like this in companies. I'm stealing a line from a very famous VC. They've never seen growth rates like this in companies, but they've never been shakier. In other words, the gross dollar retention rates aren't that good. So it's like a lot of people are trying this, but they're not sticking around to be customers. So it's like a lot of like project-based stuff right now. And I think that would imply that it's probably some sort of bubble.
Are we going to see those companies, though, the smaller ones, are they going to fail? Are they going to be acquired? I guess in terms of consolidation, I think many people would say we'll see some sort of consolidation within the space. A lot of those startups aren't going to succeed. But are we going to see more of these larger players, the incumbents, acquire some of the smaller players? I guess, and when you talk about that timeline,
pennies on the dollar.
But when you talk about that timeline, what more realistically does that look like? Everyone's excited about it now. What's it going to take for you to get in?
When we see gross retention rates go up. So gross retention rates are all. What I mean by that for the viewers is before you have any upsells or anything, you take $100 a year of revenue. The next year, do you end up with $70 if you didn't add a new customer, or do you end up with $95? Like 95 is best in class. Like think about people on Salesforce. It's like impossible to get off Salesforce or Oracle or like Microsoft Office and these products. It's very hard. But when you have like 70% gross retention rates, it just implies 30% of your customers are churning every year. And we're seeing really low retention rates. We will get interested in this stuff when gross dollar retention rates get 90 plus.
Okay, really quickly, like less than a minute here. You've said previously your biggest mistake in the last decade was not predicting multiple expansion.
Yeah.
Are you potentially making that mistake again by not getting in on AI right now?
Maybe, but that's fine. We don't have to. We can stick to boring software companies like Pacemate that make cardiac monitoring software, or Growth Zone that makes Chamber of Commerce software.
Though, 40% this year? Software is struggling right now.
That's the best time to invest in companies. But again, a huge amount of our portfolio will end up selling to private equity. So 60+% of our companies are profitable businesses where you've never heard of any of these businesses like Growth Zone or GVL or Pacemate. They'll never be giant IPOs. We don't need them to. We'll sell them to one of 100 private equity firms, or we'll sell them to a tuck into a strategic and try to make 2 to 5 times our money versus trying to bet on the IPO markets coming back. The reason the IPO market's not strong right now is if you run money at Wellington or T. Rowe or Fidelity, it's easier to go buy Microsoft or Facebook or Google or NVIDIA that are growing super fast. Because I think the biggest challenge in a lot of the software companies is if you just look across the whole software ecosystem as public companies, they're not growing that fast anymore. A lot of them have slowed down a lot.
Well, Mitchell Green, we have to leave it there. But thanks so much for coming in studio. We look forward to hopefully having you back soon and continuing this conversation. Lead Edge Capital founding partner. Thanks so much, Mitchell.
Thanks for having me in.
Keep right here on Yahoo Finance. We've got much more coming up ahead. We've got wealth. It's dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith. This is Yahoo Finance's guide to building your financial footprint. Our community of experts is going to give you the resources, tools, tips, and tricks that you need to grow your money. And guess what? On today's show, we're going to be diving in, examining the best moves for your portfolio. The tech sector booming, many people investing, but we're going to hear from one portfolio manager who names 2 other sectors worth your time and money considerations. And President Biden's new student loan repayment program has hit a new roadblock just days before it was set to take effect. We'll tell you why and what it means for your money. Plus, has your credit score taken a hit from medical debt? We've got you covered with a conversation with a financial expert who can give you the tips and tricks to rebuild your score. All that and much more coming up in today's show. But our top story, new housing data out this morning in a big week for the sector here. We've got pending home sales. This tracks the number of housing contracts that have been signed, but the transaction is not yet complete. It's seen as a leading indicator of existing home sales. Typically, it takes 1 to 2 months to ultimately close on a home. And here with the numbers, we've got Yahoo Finance's Danny Romero here. Danny, you've been tracking this one. So what do we know?
Brad, high home prices and elevated mortgage rates are keeping would-be buyers away from the housing market. Data from the National Association of Realtors shows that pending home sales, a leading indicator for the housing sector, fell 2.1% in May from the month prior. And on a yearly basis, pending transactions are down 6.6%. Now, regionally, the Midwest and the South posted a drop in contract signings in May from the month before, and that could be because there's not a lot of people relocating to those areas. That's a very different picture from the pandemic days. Meanwhile, the Northeast and the West recorded some gains. Brad?
So, Danny, put these numbers into context for us. Do they point to any recovery for the housing market?
Look, Brad, industry experts expect mortgage rates to be moderately lower, which will in turn boost more housing activity and stabilize home prices. Yet, now, there are some signs of a turning point. Data from Redfin shows that the typical home is selling for less than its listing price, and that is the first time since that's happened since the pandemic. The likelihood of homes selling below asking price is rising because there's more supply and less demand. Meanwhile, mortgage rates are sitting at their lowest average in 3 months, but that's still not enough for buyers to jump into this housing market. Data from Goldman Sachs shows that about 95% of mortgage borrowers have an interest rate below the current rate, and almost 80% of rates are more than 2 percentage points below market rates. So this recovery could take a little bit longer as these mortgage rates and interest rates remain elevated. Brad?
Yeah, the Redfin data that you had mentioned before saying a typical U.S. home that sold during the 4 weeks ending June 23rd sold for 0.3% less than its asking price. Interesting data there. Thanks so much for breaking it down, Danny. Appreciate it. Well, we're keeping a close eye on semiconductors here this morning. The sector seeing a little bit of pressure after Micron's Q3 earnings were overshadowed by the company's Q4 guidance, falling short of AI-driven growth expectations. And while the AI-fueled rally has pushed broader markets to new heights this year, let's not forget about some of the other sectors that could enhance your portfolio. Here with more is Jeremiah Buckley, who is the Janus Henderson Investors Portfolio Manager. Great to have you here with us, Jeremiah. I mean, there's been so much crowding into the tech trade, especially within the theme of generative AI, but where else are you sensing some opportunities right now?
Yeah, thanks, Brad. Thanks for having me on. I appreciate it. So there are other areas of the market that we're excited about as well. So one example would be healthcare. So we're seeing lots of innovation in biotech as well as medical devices, which continues to be exciting, and we're seeing good growth there. We're also excited about areas of consumer discretionary. So we think e-commerce continues to grow at a rapid rate. But we also think that cash-rich consumers are really in a good position right now. And so one of the areas that we like is travel. We continue to see strong recovery globally. And so those companies that are exposed to global travel trends continue to be favorable for us. And the last one, a more kind of value-oriented area of the market is capital markets. You know, we've seen a couple of years of weak capital market activity. We think with interest rates stabilizing, a lot of pent-up demand, we'll start to see an improvement in capital markets as well. And so some of the investment banks or a lot of the companies that facilitate capital markets activity we think are also attractive here.
You know, it's interesting. We were speaking earlier today with Kevin Gordon of Charles Schwab, who was talking about one of those sectors that you mentioned in healthcare. And I just want to zero in on that for a hot second, because he said as of yesterday, and he was talking to us, about some of the areas that he sees right now as weak, but ultimately saying only 2 sectors with less than half of their members are trading above the 200-day moving average: consumer staples and healthcare. What does that indicate to you, especially as you're looking across sectors and trying to figure out where there still is some broadening that is yet to take place?
Yeah, so the market has certainly been more aggressive. And so the 2 sectors that you name are certainly more defensive sectors. And so they've trailed as people have shifted capital to the higher growth sectors like technology and communications. But we think that there's attractive growth opportunities, like I mentioned, in biotech and medical devices. There's a lot of innovation. You see companies that are growing, high single digits, low double digits. And so we think healthcare can be both defensive if we do have some volatility in the markets, but it also is offensive in that a lot of companies are innovating and driving good and attractive growth.
You also mentioned travel a moment ago, one of my favorite sectors to talk about here and continue to track. When you look across what the difficulties are for maintaining margins right now, and especially as many of the airlines, if we're looking at that particular subset of the sector as well, are trying to figure out their own routes, their schedules, and the ability to take on new aircraft. How much of a concern does that kind of present as you're evaluating the overall health of that industry?
Yeah, so we're focused more on our ownership is in hotels as well as the OTAs like Booking Holdings. We think those are better business models than the airlines, but obviously the airlines are an important aspect of making sure that we have enough supply so people can fly to those hotels. As far as the airlines, I think we're seeing differentiated results between the domestic-focused airlines as well as the global airlines. A lot of our thesis around the travel recovery is outside the U.S. I think we're back to a normal trend line in the U.S. And so with those capacity additions for the airlines, that's led to some difficulty for those U.S.-focused airlines. But if you look at the global airlines like a Delta or United, they've had better results. And that's a big part of our thesis is that global travel recovery.
Jeremiah Buckley, who is the Janus Henderson Investors Portfolio Manager. Jeremiah, thanks so much for taking the time here with us today.
Thanks a lot for having me on.
Certainly. Well, denim may be in these days, but Levi Strauss' latest earnings report out yesterday shows that the consumer is still being somewhat cautious in their discretionary spending. Our own Josh Lipton has more on this and what investors are tracking on Levi's.
That's right, Brad. So they still might like the jeans.
Okay.
They might like the denim, but investors clearly not happy with Levi Strauss earning results today. The company reported a Q2 profit that did beat Wall Street's forecast, but revenue of $1.44 billion did just miss expectations of $1.45 billion, company reaffirming its full year outlook. Bottom line, that was not good enough for investors who, remember, had piled into this name. Expectations were running hot into this print. The stock had surged about 40% this year through Wednesday's close. The company's CFO was on Yahoo Finance this morning, talking with us about the results and expressing optimism about the business.
As we think about the U.S. as a marketplace, this is the third consecutive quarter of the U.S. growing.
For more analysis, I caught up this morning with Stifel's Jim Duffy. Overall, he says this report was strong with acceleration in the direct-to-consumer business. That's a solid foundation, he argues, that they can build on. So what is the issue? Jim says investors are disappointed with the wholesale business and that the company did not, in fact, raise its full-year outlook. But he's arguing this stock move we're seeing right now is an overreaction. He rates this one a buy because it is a great brand, he says, with opportunity for category expansion, good capacity for revenue and margin improvement, and a strong balance sheet. Company also just raised its quarterly dividend for the first time in 6 quarters. More broadly, what does this report tell us about the consumer? Jim says it tells us the consumer is still willing to spend when they see something they want, but they are spending more selectively right now, and you can see that in the company's numbers. Jim says with its direct-to-consumer numbers were strong, but some wholesale partners still having challenges, Brad.
Yeah, it's interesting what they said was doing well. Successes in their core space dye business. I don't know too much about that one, but I do know a little bit more about the wide leg pants that everybody's been kind of pushing on us right now.
It's a style.
It is a thing.
It's a trend. It's a theme.
Have you bought in?
No, because I don't think that's a good look for me. I try the wide leg. I just look like a fire hydrant. It's not.
I believe you can pull off anything.
You think so? I appreciate that.
Yeah.
That's nice, Brad.
All right, we're both going to give it a shot here. We'll report back here. Josh, thanks so much. Everyone, coming up on Wealth, the Biden administration's new student loan relief plan has hit a roadblock. We'll break down what this means for you and your money. Plus, are you thinking of making your side hustle into your main hustle? One of the experts is going to talk about all of this and the financial signs that you're ready to take the leap. And we've also got insights from digital banking customers. We're going to speak with Bank of America about how their clients are increasingly using digital in their financial lives. All that and much more coming up here on Wealth. A key Biden administration student loan relief plan has been put on hold. Two federal judges in Kansas and Missouri halting parts of the administration's income-driven repayment plan, known as SAVE, until they rule on the cases. To discuss, we've got Yahoo Finance's very own Rick Newman here with more. Rick, what do we know about this so far?
State of chaos. So the SAVE plan, as you mentioned, is income-driven repayment. So you can have your payments reduced based on a history of repayment and based on your level of income. So I'm not sure it's entirely clear how this legal action is going to affect the 5 million people who are enrolled in this plan. And I think it just, so first of all, it doesn't end the litigation. They put injunctions in place pending the outcome of litigation. And it wasn't for the whole plan. They didn't give the plaintiffs everything they wanted. They gave them part of what they asked for. So I'm not sure there's a bottom line here for borrowers. I think the best thing anybody can do is go to the government website that handles this. It's studentaid.gov. And right there is a button to see if you qualify for debt relief, and then sort of follow the prompts. And this is going to unfold over coming weeks and months. But I think at the broader picture here, Biden himself said, he has said many times, he doesn't think the president, whether it's him or somebody else, has the authority to do this through executive order, that it requires Congress to pass a law that would put debt relief into place and make it a matter of law rather than policy. And I think the White House completely expected all of these legal challenges. Remember, the Supreme Court last year shot down Biden's overarching debt relief plan that would have canceled or reduced debt for almost all student borrowers. So the Supreme Court canceled that. We now have other courts canceling parts of what Biden is trying to do. And I think we're going to see just ongoing legal challenges here.
The Biden campaign, they had talked about this even before taking office, campaigned on it. And now it seems like for every year during the administration, we've continued to see more of an effort to push student loan debt forgiveness. How do we expect this to come up now that the campaigning is beginning all over again?
Honestly, who knows?
Tonight?
So just to briefly go back to 2020, so Biden was not the foremost advocate of debt relief. we had Bernie Sanders and Elizabeth Warren basically saying forgive all student debt. And there's well over $1 trillion. We're talking about a lot of money here. And Biden said, no, I don't think we can go that far. He said, I might do some modified. So what Biden did try to do is forgive up $10,000 for many borrowers and then up to $20,000 for some other borrowers. That's what the Supreme Court shot down. Mm-hmm. I think the Biden campaign would say now, as it says before, this means we need to elect Democrats. We need to have a clean sweep of Democrats in the White House and in Congress so that we can try to pass this as a law and get this done. But worth pointing out, we did have a clean sweep by Democrats in the first 2 years of Biden's administration.
In 2020.
That's right. Democrats controlled both houses of Congress during Biden's first 2 years, and Biden could not get student debt relief done then. This is controversial. Whether this is a good idea. A lot of people who say if you're going to commit, and again, lots of money here. If you're going to commit $500 billion or $1 trillion of government money to some kind of social aid, this is not the best way to target it. Better to target at working moms, for example, child care aid, early Head Start, early childhood education. You get more bang for the buck that way. Right. This does actually affect it's aid for higher income people relative to the whole population. But this fight is just, this fight could just go on in perpetuity because I think it is a big problem for a lot of people who just cannot get out from under the amount of debt they have. They want some help, but it's hard getting the help delivered.
Yeah, we'll see how it comes up on the debate stage. And
studentaid.gov.
Yeah.
Follow that, bookmark that and follow it if you're a student loan borrower.
See if you qualify. Yep. Rick Newman, thanks so much.
Thanks, Brad.
Appreciate it. And guys, if you're looking to get a few extra bucks in your pocket, a side hustle could be a good option for you. A MarketWatch study found that more than half of Americans have adopted a side hustle to supplement their primary source of income in the last year. And our next guest has some tips on how to maximize your side hustle to help benefit your financial goals. Let's welcome in Josh Jones, Capitus Chief Revenue Officer. Great to have you here with us, Josh. So when is it time to turn your side hustle into your main hustle?
Yeah, first off, thanks for having me. The easy answer to that is if your side hustle is supplementing your income completely, it's an easy switch. Not everybody is as lucky as that, at least to start. But the nice thing about side hustles is it's something that your financial life shouldn't depend on immediately. You have your full-time job. If you're able to carve out extra time to establish secondary source of income, it gives you the ability to test out a career that you might be interested in without taking that financial risk. So I'm a big supporter and passionate about the topic. I myself have a side hustle. I'm a real estate investor. I'm very supportive of it. And I think many people have the ability to start a side hustle, leveraging the digital economy, becoming a blogger, a remote tutoring, Influencers have kind of run wild with it, romanticizing the idea about becoming an entrepreneur. I don't want to undermine how difficult it really is, but it is worth a shot starting that side hustle and having that secondary source of income.
Yeah, we've got a really strong wave of very good video editors out there right now who are influencers on social media. And at the end of the day, anybody who is kind of capitalizing on their side hustle needs to figure out how they monetize it. What are those first steps in figuring out even how to monetize it if it's not as clear cut as someone giving you a check for side work that you're doing, or if you have a W-4 or I-9, whatever the case may be, and you're building it from the ground up?
Yeah, I think the easiest thing to do is figure out what you're good at, right? Don't follow your passion, follow your natural talents. So if you are great and passionate about video editing, follow through with that. I think the next steps are really sizing the demand, right? It's easy to think of something that could potentially generate money, but is there demand for that product or that service that you're planning to offer locally or digitally? I think after that, the next step really would be to understand what somebody's willing to pay for that product or service. And lastly, is that income that you're able to generate from your product and service worth your time? What needs to be invested into the business to get it to a place where you're happy with the income that you're generating, and naturally getting to the point of what is the growth opportunity? Can you eventually make this your full-time job? Or is this your toe into becoming an entrepreneur? Or is it a test into another career without taking that risk entirely up front by making that switch without seeing what works and what doesn't?
When can you effectively recognize that your side hustle is not just enough to support your current life, but also may have a growth opportunity to be a bigger business as well?
Yeah, with what I do daily, we lend to small businesses, and I see over 40,000 applications monthly of people looking for capital to grow their business. And each one of those businesses, for the most part, has identified an opportunity for growth. So I think it's important to not only get to a level of scale that you can supplement your income, but really understanding what is the path forward. Do I have the ability to eventually hire? Do I have the ability to expand? And really, what do I ultimately want out of it? Because a lot of times people, they fall in love with the idea of being a business owner, but there are plenty of sleepless nights. I've done it myself. You value your employees over yourself. They're the lifeblood of your business. And those are really scary moments. And when you're growing your business, you really have to identify, okay, what do I want out of this? Is it more free time? Is it to spend time with my friends and family? Because that entrepreneurship path looks a lot different than one that is, let me maximize something, let me make it large, let me have an exit strategy, or let me just make sure that this is a family business, that I built something that is legacy worthy and I can hand down to my family. So I think it's really understanding your motivation. It will help you determine what you want to do with your side hustle.
Great tips there. Josh Jones, Capitalist Chief Revenue Officer. Thanks so much for taking the time, Josh.
Yeah, thank you very much.
Certainly. Coming up, everyone, a deep dive into digital banking trends. We'll talk to Bank of America about how clients are using digital in more areas of their financial lives. That is after the break. According to the American Bankers Association, the ABA, as you know them in your hood, 71% of Americans bank using apps on their mobile devices or online via a laptop or PC. And Bank of America says its 57 million digital clients are increasingly using digital in more areas of their financial lives. Here to dive into the data, we've had Nikki Katz, who is the head of digital at Bank of America. Nikki, great to see you. Thanks so much for hopping on the program with us. Let's talk about this digital banking that you at Bank of America and the broader industry are seeing right now. What are customers clearly tapping into and expecting of a digital banking experience as they're continuously leaning into technology?
Yeah, thanks for having me on, Brad. And increasingly, what's obvious is that digital banking is becoming more and more central to customers' relationship with their own finances. And for us, we have 57 million clients who have opted to leverage digital channels for their banking. And that number is actually growing by about 1 million a year. But even more interesting than that is the fact that they're logging in more frequently. And so the engagement numbers are far outpacing that growth. So last year, we saw clients leveraging digital channels 23.4 billion times, and that includes both, roughly 13 billion times that they came to us to log in and check their finances, as well as roughly 10.5 billion alerts that they signed up to receive from us. And so really digital is, what we're seeing is a behavior shift, where digital is becoming more and more central to our clients' relationship with their finances. They're using it more frequently, and it's helping them be better connected. And to your question around expectations, I think what we're seeing is that clients expect it to be easy. They expect it to be convenient to do their banking. They don't want to have to wait. They want to be able to self-service. And we're seeing that they're also expecting us to really partner with them in ensuring that their finances are on track. So as an example of that, we have Erica, which is the industry's most widely used virtual financial assistant. And clients interacted with Erica over 2 billion times since we launched. And what's nice about that is that Erica is able to proactively give insights to our clients, things like, hey, pay attention to your recurring subscription amounts, or you have a deposit that's coming in, et cetera.
Erica is AI-driven. How many more AI-driven experiences do you think customers are going to be able to feel comfortable tapping into, especially as they move more and continue to be more digital about their banking approaches?
Yeah, I think that customers expect a great, convenient, and smooth digital experience, regardless of what part of their lives they're interacting with, but definitely in the financial space. And so I think the way we think about it is not so much what's the technology that's enabling it, which in this case is AI-driven, but really what's the best tool for getting our customers that ease and convenience that they're looking for.
Certainly. And this comes back to life planning. Financial planning is life planning at the end of the day here too. Where do you see even more of those decisions being made, especially as you're considering what customers are trying to do, whether that's budgeting or improving their credit or making a big purchase like a home or, just trying to get a lavish, luxurious vacation, Eric? Or not Erica, Nikki. Erica's on the mind now.
It's easy to confuse us, but I think that's right. Exactly what you just named. We launched a product called Life Plan, which is really all about clients telling us what's important to them in life. And since we launched it, we've had 15 million clients set up digital life plans with us. And it's exactly what you said. The top 5 objectives that we see from our clients are budgeting and starting to save. That's literally 31% of our clients. That's what's on their mind. Improving their credit, saving for a large purchase, buying a home, travel. That's what's on their mind. And then the other thing that we're seeing just through their behavior is they want it to be easy. They want it all to be in one place. And we've been on a journey to ensure that our clients can see every aspect of their relationship all in one app, whether that's banking or investment or retirement. And so they're responding. They're leveraging the app more. They're using it more as a result.
And just lastly, while we have you here, I only got about 30 seconds. Zelle has been massive for the entire financial industry. Zelle, other peer-to-peer transactions platforms. Where do you see banks and the industry leaning further into platforms like that, knowing the amount of consumers that it does connect?
Yeah, I mean, again, another example of customers just shifting completely into digital. I mean, to underscore what you just said, Zelle transactions at this point exceed the combination of both cash and checks. So customers are using Zelle at that level. It's completely surpassed cash and checks. And just to put a number on that, last month alone, we saw exactly 132 million Zelle transactions totaling a record $39 billion. So I think where it's going to go is customers are going to continue to pick up these technologies and leverage them. We're going to continue to see adoption, and whether that's Zelle or Erica, customers are going to continue to expect things to be fast, easy, seamless, convenient. And we're going to see those numbers continue to grow, and customer expectations are going to continue to evolve and change. They're going to expect everything to be fast, real time, easy in the way that digital has made it.
Really fascinating. Nikki Katz, who is the head of Digital Bank of America. Thank you so much for taking the time here with us today. Appreciate it, Nikki.
Thanks for having me, Brad.
Certainly. 41% of Americans have medical debt. That's according to KFF. And those outstanding balances can take a toll on credit scores. To discuss medical debt's impact and how you can rebuild your credit, we've got Monique White, who is the self-financial head of community and financial expert, back here with us. Monique, great to see you. First, we got to figure out, number one, when you do take on medical debt, what are the first steps that you can take to start to make sure that it doesn't hit your credit score or loom over your credit score for too long?
Brad, thanks for having me back. That's a great question. We know it's no secret that millions of Americans are burdened with medical debt right now. And it's really important to be proactive with that debt. It's a little bit unique than any other consumer debt. So right now, the current policy is that a hospital has 18 months to collect that debt from you. And they also cannot report any medical debt under $500. So there are some steps you can take. First is to review your bill, do your due diligence, make sure everything is making sense, contact that hospital, see if you can come up with some type of payment plan or good faith payment so that it does not hit your credit report. And then also just knowing your rights. As I stated earlier, they have 18 months to try to collect that debt. They cannot report anything under $500. So keeping a monitor on your credit report is extremely important so that if you do see those inaccuracies on your credit report, you can look into disputing that.
What happens after the 18 months?
Yes, so I think it's important to address, how medical debt impacts your credit report. So if you have an unpaid medical debt, it can get sent to collections, and that collections account can potentially damage your score up to 50 points. It can also remain on your credit report up to 7 years. And although medical debt is not weighted as heavily into your FICO score as other consumer debt, it still did that initial damage to your credit score, which just makes it a lot harder for consumers to get their finances back on track.
Yeah, certainly. And so say you have seen an impact, a hit to your credit score because of medical debt. Where can you perhaps seek some remediation from that?
Yeah, that's a great question. So there's 3 things you can do. Just like the advice earlier, review your bill. Make sure everything looks accurate. If you need to contact your insurance company or the hospital to review your bill, you can definitely do that. The second thing is to seek support for that. There are agencies in your area, like for free coaching and free counseling, where a coach or a counselor can sit down and come up with an action plan and figure out how you can manage some of this debt. If someone is coming off of a medical emergency, they might have some residual stress from that. So it's really important to try to get support for that. And the next thing is to consider adding additional trade lines to your credit report so that you can generate some type of positive payment history.
Monique White, self-financial head of community and financial expert. Monique, great tips, actionable as we need them. Thank you so much.
Thank you.
Certainly.
Thanks.
Coming up, do you want to work in space or maybe just for a company that's focused on the space industry? Well, up next, we have an expert that can tell us all about the top jobs in space and where to find them as part of Yahoo Finance's Space Race Week. Stick around. 233,000 people filed for first-time unemployment benefits last week, trickling down from the week prior. For more on what this could mean for the labor market, we've got our very own Rochelle Akufo all across the labor market and the employment economy space. Rochelle, what do we know?
That's right. So obviously, this is just a piece of the picture. But as you mentioned there, initial claims softened to 233,000 for the week ending June 22nd. Now, that was down 6,000 from the previous week and lower than estimates of 235,000. Now, while first-time filing data, that is a better leading economic indicator, the standout data point was actually in continuing applications, also called insured unemployment. Now, that actually hit the highest level since 2001 at 1.84 million. That's 1,839. For the week ending June 15th. Now, that was actually a jump of 18,000. So essentially, this means that people are staying unemployed for longer. And as weekly data can be volatile, keep in mind things like holidays, including Juneteenth, you have schools letting out for summer, etc. The closely watched 4-week moving average of new claims, that tends to be a more accurate gauge. But even that rose by 3,000 last week to 236,000. Now remember, workers are also consumers who spend, so that has a domino effect on the demand for goods and services and, of course, the economy's performance. So really have to look at the big picture that this data is showing us.
Yeah, that's right. So how can investors kind of use this data for their portfolio?
Well, most importantly, no knee-jerk reactions. We do tend to see with initial jobless claims that can affect some of the short-term market sentiment as they sort of just take that one piece. But it is better to use sustained trends versus single data points that come out. And you couple that with other economic indicators like GDP growth, consumer confidence, inflation, as well as, of course, what we hear from the Federal Reserve commentary as well, to really get a comprehensive picture of the economy. And of course, we're also going to get more nuance on the big jobs number that's coming out on July 5th. Keep in mind, if we do continue to see sustained softness in the labor market and that impacts economic growth, we'll also likely see more inflows into defensive sectors. Think utilities, consumer staples, and healthcare stocks. They do tend to perform better during economic slowdowns. And of course, investors will be watching to see how the Fed reacts to this as they take this piece of the puzzle in their interest rate picture as well, Brad.
Rochelle Akufo, thank you so much. Teeing up this broader labor situation discussion next here. Thanks so much. Well, lots of kids grow up wanting to be astronauts, but while very few people actually get to strap into a rocket and fly off to space, a lot of people work in the industry that makes it all happen. So how do you find the right job for you in the space sector? Joining me now, we've got Tom Kelly, who is the CEO of Ivona, which is a staffing agency for the space industry. Tom, great to have you here with us today. A lot of people want to go to space or at least be space touching somehow, in some fashion or another. What are some of the top ways and roles that are starting to open up in this industry?
Sure. Yeah. First of all, thanks a lot for having me on the show. Thanks a lot for doing the Space Week as well. I think it's important to really push out the message that the space industry is open for everybody. There is a bit of a narrative at the moment that it's all about the tourism, and that's actually a very small part of the industry. It is extremely broad. So I think that, the first key message is that the space industry is open for everybody. We've placed roles in everything that you could ever imagine, from admin through marketing up to sales, CEOs, and the industry is welcoming of people with skill sets from outside. But I think, one really important thing to mention as well is that space is very unique in its culture. I think it's derived from the fact that most people think it's just rockets. In fact, it is a lot more than that. But once you actually start to understand the sector, you realize that, and I believe it's to do with the fact that most people are working on technology that doesn't actually exist on Earth. People are humble, people are approachable, people just want to do really well and really push things forward for humanity. So the culture is fully, there's nothing else like it. As referenced on the slide there, engineering is obviously a huge part of it. These are kind of normal skill sets that you would find. So electrical engineering, systems engineering, embedded software, mechanical design. You can see there the kind of depth of the seniority, but most of the positions are engineering. And these are the sorts of salaries that you can expect if you to come and work in the space industry. So again, forget this kind of slow moving industry purely about the government, probably a lower salary. This is new space, VC, private equity backed, sexy companies that are looking to do incredible things.
Yeah.
Some of the companies that we've been to see are just insane. So as you can see there, the salaries are pretty much consistent with the tech sector. Space is now, in fact, deep tech. It used to just be hardware, and now it's really, really, really evolved. In terms of like the key locations for the space in the US, it's overwhelmingly West Coast. If you look across the investment into companies over the last 4 years, which incidentally really did peak in 2020. It slowed down a little bit in 2022. I think investors started to realize that they need to have a return on this very interesting tech, and now it's bounced. But it is predominantly West Coast. Colorado is the second. Both those locations are traditional aerospace areas, but interestingly, with about 8% of the investment is Florida. There you have the rocket launches, Texas.
So with that in mind, Tom, sorry, just want to jump in here. I mean, where are we seeing the most space jobs? You mentioned some of the locations, and they come to mind naturally for a lot of viewers because those are bases where there have been a lot of government operations previously. There are a lot of new private operations that are coming online too. And so where are you seeing the most of the positions in that kind of public versus private jousting, especially when there is overlap in some of those contracts for the industry?
Yeah. There's definitely been a shift. There's been a shift from the primes. So when we say primes, we're referring to NASA, to Lockheed, to Boeing, etc. All bidding on the same work as other much smaller companies. But now the government are actually interested in providing these pieces of work to much smaller companies, which is fantastic because it pushes the innovation, it changes the way in which these companies look to work on longer term pieces of work. What we see is predominantly the contracts are going to the VC-backed businesses at the moment. The core growth areas that we've seen over the last few years has definitely been in Earth observation. So what we mean by that is effectively businesses who are using space technology to monitor Earth and then make actionable decisions off the back of that. So I live in Florida. Hurricane season is upon us. We wouldn't look into those without all the technology from space. But space is all around us. It's absolutely everywhere. The satellite will soon be a smart desk. You won't be able to do that without the technology from space. The cell phone soon will be able to have perfect phone signal everywhere. Not sure if we spent much time in the UK, but that's incredibly useful because it's very
I can imagine that would save a lot of people some pain, some agony of losing that reception for sure. Tom, we got to leave things there on the day. We're running short on time here in the show. Would love to have you back though and continue this conversation. Very important one for sure.
Absolutely. All right. Thanks a lot.
Thanks so much, Tom. Tom Kelly, who is the Evona CEO. Everyone, we've got much more wealth after the break. Stick around. You're watching Yahoo Finance. There's a real reluctance to commit to big discretionary purchases as more Americans are piling on credit card debt. And our next guest is looking to make purchases more affordable by allowing sellers to trade in an item that they own to reduce the cost of a new purchase right at checkout. Joining me now to weigh in on the launch is Bastian Lehman, who is TipTop founder and CEO. Bastian, great to have you here with us. All right, first, just how would this work in practice? What goes into the verification process and kind of understanding what type of value someone would get for what they're trading in order to put that value towards a future purchase?
Good morning, and thanks for having me. Let me dive right in. You just mentioned it. TipTop is this incredibly exciting product that we're launching today. It's a new way to pay for things, maybe a new way to pay for things since the credit card. What we do is we allow you to trade in things you no longer need when you like to buy something new, right at the checkout. And that is really what is the key messaging piece here. If you're at the checkout, right when you want to buy something, we allow you to offset the cost of that new product by trading something in. And the whole process takes a couple of seconds.
What's this limited to? I mean, can I trade in old shoes in order to get some new ones? Like, where are you finding some traction right now early on?
Well, your old shoes may probably be better off at the Goodwill. But I'll tell you what, the average U.S. household has around $2,500 worth of goods that can be traded in and that we match with our catalog. There's around 50,000 products and growing that we have in our catalog, and that accounts to around $280 billion worth of goods in U.S. households. So I think about it as a bank account that American customers don't know they have, and we give them access to it.
What is the strategy here for TipTop? How does TipTop see its revenue model, its profit model even going forward?
We want to offer this incredible superpower to the customers, and we won't charge them. We charge a modest fee to the merchants that participate and that integrate TipTop on the checkout. And ultimately, we hope that there is enough margin in the products that we're purchasing from customers and that we're ultimately going to resell.
Certainly. This is a tough capital environment. How well-funded is TipTop, and how do you kind of look across the entire landscape and say where you're going to deploy this capital to make sure that you can get to that next growth phase as well?
We're a very small team. We're only around 14 people, very engineering heavy. And we're focusing right now exclusively on the customer experience. We want to get something out there, and we believe we did get something out there that customers love and that customers love to use. When you launch a company and when you run a startup, your biggest job really is to test a bunch of hypotheses in really fast order. So we're extremely excited about getting the product into customers' hands, and hopefully it means that we now have to shift our focus to scaling. Now, a few of us have built Postmates before, and we had to scale in a market that was totally foreign to us extremely fast. So we feel well equipped for the scaling challenge ahead.
Okay, so you mentioned it. You are also one of the co-founders of Postmates. You sold your business to Uber a few years back. Look, I mean, I think we can call you a serial entrepreneur or serial founder at this point, and you've seen success at doing it. Other owners out there, if they're looking to sell, what should they know about how to scale up their business and how to make it appealing for a large buyer like an Uber potentially to make sure that it still has a go-forward strategy too?
I don't know if I know too much about a strategy to get someone to buy your business, mostly because we never intended to sell Postmates. So it's probably a good idea to just focus on building a lasting company. And what happens is that potential buyers will ultimately notice that. And you can get extra credit for building something that ultimately becomes inevitable, and someone has to buy your business. I think that's always a very strong position to be in. But building something with the intent of selling it, I wouldn't know much about it.
I mean, were you proud? Was that a proud moment when you were able to see something that you built up have such value that a large company wanted to continue to make it successful under their own umbrella?
Postmates as a brand is still around, and I'm very proud of that. And I'm also very proud that the majority of all the team members from Postmates found a way into the Uber organization. Many of them are now in leading roles within Uber, especially on the engineering side. And I think that speaks a lot to the quality of engineers and product designers and product managers that we had at Postmates. So I'm very proud of that.
Bastian Lehman, who is the founder of Postmates and, of course, the founder and CEO over at TipTop. Would love to check back in the future on the TipTop business. Thanks so much, Bastian.
Thank you for having me.
Certainly. Let's do a final check of the markets here as we're taking a look at the major averages. We are mixed right now, the Dow in positive territory. However, we've got a little slippage on the on the S&P 500 and the Nasdaq in negative territory. The Dow is green though. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. Market Domination starts 3 p.m. with Julie Hyman and Josh Lipton.